right, well, we're ready. Let's go ahead and call the 2021 NCOIL summer meeting, the Financial Services and Multi-Line Issues Committee. Let's call that meeting to order. If you would, Will, please call the roll.
Sure. So, Senator Rapert?
Here.
Assemblyman Cooley?
Here.
Representative Gooch?
Here.
Representative Fisher?
Here.
Senator Klein? Senator Vita?
Here.
Senator Hackett? Representative Carter? She was here. Delegate Westfall? Here. We have Representative Lewis here. And Representative Rowland. And if you want any other legislators on Zoom want to identify themselves?
Anybody else on Zoom?
Okay, and anyone else here in Boston that I did not call? Representative Tracy Bowe, Senator Holdman, Representative Meskers, and Assemblyman Blankenbush.
All right. All right, I'm going to ask for a motion to waive the quorum.
So moved, Mr. Chair.
Can I get a second? Probably move the second. All in favor?
Aye.
Aye.
Opposed? Quorum is waived. Can also get a motion to adopt April 16, 2021 committee meeting minutes.
So moved.
Second.
Can probably move the second. All in favor?
Aye. Aye.
Opposed? All right, minutes are approved. We're going to have a slight change in the agenda. We're going to start with Senator Rapert, and we're going to discuss the NCOIL Uniform Captive Insurance Model Act. Joining us today, we're going to have Richard Smith, President of Vermont Captive Insurance Association, Sandy Biggleston, Director of Vermont Captive Insurance Division, and Dave Provost, Deputy Commissioner of the Vermont Captive Insurance Division. And before starting with the speakers, I want to first recognize the sponsor of the model, Senator Rapert, for brief comments.
Thank you, Mr. Chairman, and I appreciate you. I'll be very brief today. I'm really looking forward to being there in person for our next meeting in Scottsdale that will be coming up in November. And sorry that I couldn't be there in Boston with everyone. I just want to express my support for this model and for captive insurers in general. At its last meeting in April, this committee, Mr. Chairman, had a very positive introductory discussion on this issue and the language that's before you in your binders on page 247 today. Since that time, I've officially signed on as the sponsor of the model language, which is really a compilation of several states' captive insurer statutes. As you may know, Vermont has been a leader in the captive insurance industry for over 30 years and is regarded as just not a national leader, but also a global leader in captive insurance, as Vermont is first worldwide in gross written premium and assets under management and ranks third in the number of active captive insurance companies. And if I got any of that wrong, I'm sure our Vermont folks will correct me. Accordingly, having representatives from Vermont here today to discuss their experience in the captive insurance industry will be extremely beneficial to ensuring that the model ends up being the strongest possible piece of work product that it can be. The model can end up providing states guidance when they are looking to develop a captive insurer statute and can send a signal to those states that captive insurance is something that NCOIL supports, provided there is an appropriate statutory framework in place. I think by our next meeting in November, we can have a version of the model ready for consideration by the committee. I want to thank you, Mr. Chairman, and I'll turn it back over to you. And unless you have any questions for me, sir, I have to move on to my next scheduled duty.
All right, well, I look forward to seeing you in Scottsdale.
Thank you very much, and I hope you have a very successful meeting in Boston.
Thank you, sir.
Thank you.
All right, we will pass it now to Richard Smith, President of the Vermont Captive Insurance Association.
Good morning.
Mr. Smith.
There we go. Okay, there we go.
All right.
Great. Thank you, Mr. Chairman, and thank you to the folks at NCOIL and the rest of the senators and representatives here for this opportunity to come down and talk about the Captive Model Act and talk a little bit about Vermont, give you a little bit of background on how our legislation evolved and some of the important aspects we see in terms of any kind of legislation that's going to either establish or update captive industry laws in individual states. So first we'll do some quick introductions. Again, I'm Rich Smith. I'm the president of the Vermont Captive Insurance Association. I've been head of the association for the last 10 years, and I'll talk just very briefly about the association a little bit later on, but I'll turn it over to Dave and Sandy.
Thank you, Rich. I'm David Provost. I'm Deputy Commissioner of the Captive Insurance Division for the state of Vermont. Along with Sandy here, we're responsible for regulating captive insurance companies that are domiciled in Vermont and working with our legislature to keep our captive law up to date. Sandy?
Thank you for having us here today. I am Sandy Bigglestone. I'm the Director of Captive Insurance. I've been with the Vermont Department for 24 years, and I am Dave's right-hand person with legislative initiatives, licensing new captives and approving changes in business plan, and including NAIC initiatives and all other duties. Thank you. Yes, so this slide is just to give you a little idea of some select information of why Vermont is the leading U.S. domicile for captive insurance business. We've been in the business for over 40 years, and it started in 1981 with a simple legislation called the Special Insurer Act. And our law has been adapted many, many times over the course of 40 years to meet the changing needs of the industry. So I think that's an important piece. We do have, as of the most recent year end, $30 billion in gross written premium, $197 billion in assets. And Vermont is a small state, so we have a great economic benefit to a small state like Vermont for our captive insurance industry existing there. And but what's important also is that Vermont's captive industry represents 10% of the overall captive industry in the world. We are a leading domicile for risk retention groups, which are group captives formed under a federal act. And we do Vermont chairs the risk retention group task force at the NAIC. And just a piece about our expertise over the years, the folks that are involved in the business, the infrastructure, which includes all aspects of government, the industry association, the service providers in Vermont, and the fact that we can be innovative has awarded us the gold standard of domiciles.
And just very briefly, so what is Vermont Captive Insurance Association? We're the largest captive trade association in the world. We have nearly 400 member organizations, and these organizations rank from Fortune 50 companies to small nonprofit hospitals. As you can see from this map, our members come from almost every state in the union, plus we have members from different countries, Switzerland, Japan, England, and others. So we have a breadth that really represents, as Sandy mentioned, a wide swath of the captive insurance industry. I'm going to turn it over to, I think, Dave or Sandy. And I know you've already had a brief from our friends Anne Marie Toll and Gary Osborne at your last meeting about what a captive is, but we'll just do a quick overview of that if we can.
Yes, very quickly. The word captive inherently implies control. So a captive is an entity licensed and controlled by its owners and covering the risks of its owners. It can write policies of insurance directly to its owners who also can interact with the commercial insurance carriers on a reinsurance basis, and reinsurance is just insurance for insurance companies. And captives are licensed and regulated in a single jurisdiction and usually under special insurance laws. If we can go to the next slide, I think I'd like to point out some similarities to typical commercial insurance companies. If you think of an insurance company like Liberty Mutual or Farmers Insurance and how consumers buy insurance, so I think making this comparison will help put it in perspective a little bit about captives and how they are similar. One, they're licensed insurance companies under state laws. They set insurance premium rates for risks it chooses to underwrite. They write insurance policies and collect premium and pay claims against those policies that they write. On the next slide, some comparison and contrast to traditional insurance companies and captives. Captives are typically only licensed in the state of their domicile. Commercial insurers are licensed in all states, whether they're domiciled or writing. Captives write policies to its owners and affiliated businesses. Traditional insurers write policies to anyone. State regulators are focused on a business plan and solvency of a captive, although certain types do fall under NAIC accreditation standards, like risk retention groups, who can register to do business in states under the Federal Act. Traditional insurers follow NAIC accreditation standards, with all states applying those standards on a substantially similar basis, the focus being financial solvency and consumer protection. Regulatory practices for captive compliance and solvency measures are primarily derived from the standards developed by the NAIC. These are standards that all insurance regulators do focus on. Because captive insurers, insurance is not focused on insurance for consumers, we took the best of those NAIC standards and tailored them to the business of captive insurance. Traditional or commercial insurance companies employ people who run the operations of the insurance company, whereas most of the time, captives are managed by service providers with expertise in insurance operations and accounting.
Next slide, Rich. So I looked around the audience this morning, excuse me, and about half of you might remember that cover of Time magazine. We went for it. There we go. And the other half is probably too young to remember Time magazine. But years ago, this was in the early 80s, we had a hard market in insurance. We are back into a hard market now. Unlike consumer insurance, there's lots of folks, lots of companies, Geico, Allstate, State Farm, that are willing to sell consumers auto and home insurance anytime, any day. In the commercial insurance marketplace, there are times when you cannot buy insurance. It's not available at any price or any reasonable price. And that is why, one of the primary reasons why companies form captives. So Rich, the next slide, if you would. So captives are all about control of companies taking control of their insurance buying and their insurance availability. If they can't buy insurance on the open market, they form their own insurance company and then use that company to self-insure risk or to buy reinsurance on the wholesale market. It is all about control. Again, it is financing risk, it is managing risk. A captive provides a certain amount of self-insured discipline or self-imposed discipline on a company's insurance and self-insurance program. You can self-insure, you can do everything you can do in a captive just by saying, I'm not buying insurance. I'm going to take care of those losses myself. But with a captive, you are forced to put the money aside in advance. And that money is watched over by regulators and examined by regulators. And that's the big difference with a captive. It provides a lot of discipline. It provides a board governance. It's another subsidiary in a corporate structure that then has to go up and be looked at by the corporate, by the C-suite, by the president and CEO and general counsel. So it is really all about discipline in insurance buying. So as you go forward with this model, there's some things that we really think you need to consider. For one, there's over 60 domiciles in the world right now and over 30 states with captive insurance laws already. These laws are dynamic. Most states adopt these laws from existing captive domiciles, and all of the states that wind up in the captive insurance business wind up adapting these models every year and changing. So just keep in mind that this model will need to keep up with the world around it. It needs to be a dynamic model. It can't be stagnant. Otherwise, it's going to fall behind pretty quickly, because we do change our captive laws every year to keep up with the insurance marketplace. So that's something to really consider. Plus, you're already going to have 30 states with captive laws that might not match the model. So you're going to get a lot of input, I think, from those states that don't follow the existing or the model that you're proposing. So they're either going to have to make some changes, or they're going to have to make changes to the model. So there's going to be a lot of back and forth, I think, in that discussion. And I just want to talk very briefly about why states form captive laws or pass captive laws. There's really only two reasons. One is to support your local industry, so that your industry can form a captive in your state and they don't have to fly to Bermuda or the Cayman Islands or Vermont to have their board meetings. And the other reason is for economic development. That's why Vermont passed it. That's why Hawaii passed a captive law. We don't have industries that are going to support a captive insurance business in Vermont. We're a very small state. You put us all together and we're about the same size as the Boise, Idaho metropolitan area. So a few jobs and a few tax dollars makes a big difference in Vermont. It took us 40 years to get up to 400 jobs. Most states can do that with one factory in a weekend. So it's a difference. So at any rate, if you're going to support local industry with a captive law, there are plenty of models out there. If you're going to try to form a new business in your state and use this for economic development purposes, I'm not sure a model is where you want to go. You kind of want to build a better mousetrap. So following the same model that everybody else does isn't going to provide you much of a business edge in that regard. Maryland did a study a few years ago about captive insurance and whether they should pass a law. And the study came back with there's very little downside risk to any state. And so I think there's very little downside risk to a model and to examining a model. On the other hand, there wasn't much of an upside. Unless you have a local business industry that can support a captive domicile, there's already so many choices out there that you're going to have a hard time competing with other states and other domiciles around the world. So I guess I'll quit there while we're out of time, but just things to consider as you go forward with this process.
Sorry, Dave. Yeah. Yeah. So thank you all. I would love to open it up for questions. Again, we really appreciate the reasons the model law is before you today. Support of the industry, the captive industry, is hugely important to us, and really appreciate you folks looking at it. I think for us, providing a roadmap for other states, either to, in terms of establishing a model law or establishing a captive law or updating their own captive laws, is a terrific idea. But one of our concerns is putting a model law out there, that doesn't have the flexibility or could potentially sow confusion amongst other regulators in terms of, states like Vermont that have updated their the captive law and evolved that law to, as Dave mentions, to meet the evolving needs of the industry. It happens on a regular basis. As a matter of fact, our VCIA works with the state of Vermont every year to go into our legislature and tweak the laws, sometimes make major changes, sometimes just minor tweaks, but always looking to update our laws to make sure they meet the requirements for the industry going forward. So with that, thank you, and open it up for questions, comments.
All right, thank you so much. Do we have any questions from our legislators?
Go ahead. Yeah, this is Senator Hackett. Yeah, I have a question. Gentlemen, I carried the legislation, and lady, I carried the legislation in Ohio, and And I appreciate you saying that, states are different and the reasons they're doing it, et cetera. Ohio was a state that we had so many domestic carriers. It's a big insurance state, and we were losing so much existing business with existing captives. So when we set our own captive law, we got a lot of business that came in. But we did not want to have an aggressive captive situation because we have the other insurance companies. And for example, we do not allow association captives. And I realize when you look at the model law, I mean, a lot of times NCOIL tries to create the framework and to let the states put the policy in it and decide how they want to handle the law, et cetera. But each state is really different in how they do that. I mean, like for Vermont, and I thought Vermont was great, but Vermont is, their thing is they want the business. I mean, they're a captive state that really wants business from other states. Ohio really wasn't. We just want to take care of our own corporations, our own insurance companies, et cetera. So maybe we'll change. But when you make the statement that there's less oversight, I mean, there's as much oversight. There isn't as much oversight between traditional carriers and captives. There is better oversight when they just self-insure the company. But captives, the path to an oversight from the Department of Insurance is less than the regular oversight you see with insurance companies. So you have to be careful that you don't get too aggressive. You guys are pretty aggressive with your captives. You've never had a captive go under in all your years. You've never had problems with a captive. That's my question. Because you are a lot more aggressive than Ohio.
Sure. I'm going to answer that with, you're absolutely right. The regulation is different, but there's a good reason for the different regulations. One is that traditional insurance companies provide insurance to the general public, and a captive provides insurance only to its owners. So when we look at a captive for a Fortune 500 company, it is self-insurance. They have the money, they have the assets, they have the resources to insure themselves. In fact, they very often have more resources than the insurance company that wants to sell them insurance. There have been failures. Enron had a captive. Enron went under. So when a captive parent fails, the captive is going with it. In that case, we have the same laws that traditional companies have for liquidating an insurance company. So there's a very good reason for the difference in the laws, and that really is the risk involved between insuring the general public and insuring yourself. But you're absolutely right. There is, not every state is going to want to form a captive market for captive insurance companies. A state like Ohio has a lot of industry that you want to provide a captive solution for those industries, just as a home state solution. And that's wonderful. That's common. Sure. Sure. Enron obviously was very unusual. It went bankrupt overnight. It wasn't a long process like most failures are. So when Enron went bankrupt, the next day we went to court and seized the captive insurance company. We looked at the assets and garnered all the assets that we could. And then like we would with any other liquidation, we handed it over to a liquidator who then spent the next few years settling all the claims, paying them all out. And at the end of the day, there was a little bit of money left over that went back to the Enron estate. So it's exactly the same process. In this case, it was much quicker process because Enron, again, went down the tubes overnight, but we were able to seize control of the captive, garner its assets, pay its claims, and close it down.
All right, Senator Holden. I'm sorry.
Thank you. Travis Holdman, Indiana Senate. I'm somewhat familiar with the captive industry, and I know the IRS has taken quite an aggressive stand against captives, or at least justifying the formation of a captive on behalf of a company. I'm speaking specifically to 831B captives. Other than having actuarially determined premiums, actual policies in place, claims, risk distribution that's required, where do you think the IRS, where do you think the service is going with their oversight and their scrutiny of Section 831B captives?
Well, I'll start with Vermont does not define captives by their tax elections. The 831B is a tax election whereby small companies can be taxed only on their investment income. And in order to do so, you have to qualify as an insurance company under the IRS's rules. The IRS has been very aggressive in pursuing those that promote this as a tax haven. We look at insurance companies and captive insurance companies from the insurance perspective, and your taxes are your business to the greatest extent possible. When we see somebody who is focused on the 831B election, we pretty much say, no, thank you, we're not interested. The IRS has gone after promoters of the 831B captives with, you're selling an insurance, you're selling a tax deduction rather than an insurance product. And that's been their focus. And I think it's totally justified. But if you have formed your captive properly with the proper structure and the right actuarial analysis and the right reasons for it, as in what's the insurance problem you're trying to solve, then you have no issues with the IRS.
Thank you.
You know, if I could just do a quick follow-up, but we've met a number of times with officials at the U.S. Treasury Department and have supported, you know, the fact that there are what I consider unscrupulous folks who are pushing these micro captives or 831Bs as some sort of a tax play, I guess, as opposed to an insurance company. And as Dave mentions, that doesn't fit the Vermont model, it shouldn't fit any captive model. We are concerned that there is this kind of spillover effect where folks hear about these 831Bs and then think the whole captive industry, that's how they operate. And that's a problem. That's a concern we have. I think the IRS, I'm concerned that the IRS also has that view to a certain degree, to be honest with you. We've been supportive of what they've done in terms of moving on and focusing on some of these other actors. But the concern we have is that it's the broad brush as opposed to the laser on the bad actors. And so that is something that we are dealing with and have broad concerns about for sure.
Thank you. Ms. Bigglestone, I know because of the technology, I couldn't see, I could see you right at the end. I think, did you have something to add?
Sorry, I missed that.
That was for Sandy Bigglestone.
Oh, Sandy, do you have something to add? Sorry.
Yes, I was just going to add that, state insurance regulators do have the leeway to be the gatekeepers of business, regulating captive insurance business and letting in business that makes sense, that is lawful, that is meant for insurance purposes, insurance risk financing purposes. So, the state insurance regulators do have an obligation to implement sufficient regulatory practices to oversee the business that they're letting in.
All right, do we have any other questions? All right, hearing none. Please take note that we will, this topic will be further discussed and possibly voted on in our November meeting in Scottsdale. Thank you.
Thank you.
Thank you.
Thank you.
All right, next we'll go back to agenda item number 1, which will be the discussion of the NCOIL Remote Notarization Model Act. And this topic, we first discussed this at our December meeting, and our last meeting in April. Draft model language was introduced, which I've now agreed to sponsor. The language is in your binders on page 243. One change that has been made in the language since April is in subsection D on page 245. The number of years in which the recording must be retained has been lowered from 10 years to 7 years. I think 7 years is more in line with the modernization efforts, and it would reduce the cost of compliance with the act. And it's also in line with several attorneys' record retentions requirements, including here in Louisiana. We have a 7-year retention requirement for attorneys. So it's going to be more in line with that. So saying that, joining us today, we have Nicole Booth, Executive Vice President of Public Affairs at Notarize, and Jacqueline Phillips, Director of Notary Engagement and Education at Notarize. Ms. Booth and Ms. Phillips will be providing us with a demonstration on how the remote notarization takes place. I think this will be beneficial for the committee to see. And then I believe the model will be ready for a vote at our next meeting in November. Ms. Booth and Ms. Phillips, the floor is yours.
Thank you. Are you ready? I am getting there. Thank you for your patience. We need just a second to make sure everything is working. Ready? All right. Thank you for having us here today and for allowing Notarize to present to you. As stated, I'm Nicole Booth, Executive Vice President of Public Affairs, and with me I have Jacqueline Phillips, our Director of Notary Engagement and Education. Just really quick, Notarize is a digital trust provider. We're a platform that integrates technology with live human interaction to establish identities. We offer digital identity proofing and authentication services, including a market-leading notary public platform to allow any person or organization to get their documents notarized 24/7. Access to digital services is more important than ever, and so we thank you for your leadership on holding discussions on digital services like remote online notarization to make sure they work not only for consumers, but all parties, attorneys, notaries, and all citizens. So today, we're going to give you a quick lay of the land on state remote online notarization law, and then we're going to dig into an example of how remote online notarization can work, specifically using our platform, of course. So far in 2021, 10 additional states have passed permanent remote online notarization laws, which allows for documents to be notarized online through multi-factor authentication and live audio video. 6 of those state laws have been signed by their governors: Wyoming, West Virginia, New Mexico, Kansas, Arkansas, and Oregon. And we are awaiting governor signatures in 4 additional states: Illinois, New York, New Jersey, and New Hampshire, which we count, as you're looking at this map, when the governor signs the law, then we count it on part of this map. So I wanted to highlight those 4 additional states. So if you're looking at totals, we have 35 states that have passed, or we have 35 states that have signed permanent remote online notarization laws. And once those remaining states have signed their laws, fingers crossed by the end of this year, we'll be up to 39 states. So with this review, let's move on to how remote online notarization works in real time and real practice. And nothing like your computer going out right when you're about to go on. While Jackie is getting us up and loaded, today we're going to walk through the signer and notary experience. Think, I'm just a document that needs to be signed, and you can hum Schoolhouse Rock to it if you prefer. That's what I like to do. I'm going to be taking you through this experience as a signer, and then Jackie is going to be my notary. Okay, so we're going to start here at the signer's dashboard. This is my dashboard, and I've already signed up for a notarized account, so I can come back to this account at any point. I've already uploaded my document, but I can upload my document here. And we're going to continue to the document. So once I've uploaded, I'll be prompted to enter my name as it appears on my ID. And this will help when we're going through credential analysis, which we'll get to in a moment.
This already starts the purposeful, multi-layered approach of fraud prevention and safety and security. And we ensure the three-factor authentication of something you know, something you have, and something you are. So then I'll be prompted to see if a second signer is needed. For purposes of this demo, we are going to skip this step. I do not need a witness or a second signer. So here we are. Today we're going to go through a vehicle release form. And at this point in the stage, I'm still in control of this document. I can adjust and move my name anywhere on you would think that I would know how to do that. There we go. I can move around things on the vehicle release form to make sure everything is uploaded. Some of this had been uploaded so we can move forward with the speed of the demo. So once I have done any additional edits to this document, I'm done editing and I can move forward. So this is important. I will need to go through a quick tech check to make sure my internet is strong and my audio video are set up correctly. Per law, like I said, this is important because it's not only about a good experience for me to have as I'm getting my document signed, but it's the live human element of the signer and the notary to be able to see each other and interact back and forth as part of that safety and security piece. So I'm going to continue, and you can see me. I'm in there now, I can see myself. I'm checking the output. You can see that my voice is being heard. And then the last step is they're checking my internet connection to see how strong my internet is. Now it says my connection is weak, but we can still use the platform with a weak connection. So if you're in a rural area or you don't have the best Wi-Fi, this is still an option for you to use it no matter where you're located. We're going to connect anyway. So once I'm done with that, I can move on to the identity verification stage. It is, again, a part of this multi-layered safety and security process. We're going to check my name. We're going to check my date of birth. And then what I'm going to do is use only the last 4 digits of my social security number. That's not it, in case you're wondering. And this is going to help our third-party vendor perform dynamic knowledge-based authentication. We do not share this information. And in fact, we only ask for the pieces needed to do the third-party dynamic based authentication. It's only to help us complete this next step of the process. So everything looks good here. I'm going to continue. And now what we're going to do is go through those dynamic KBAs, or knowledge-based authentication questions. We use a series of third-party databases to draw up these questions. So before I get into the program, I'm going to explain how it works, and then we're going to walk through it. So to pass this step, I must answer 4 out of 5 questions correct in 2 minutes. I can do that twice. If I get it wrong once, I have one other shot to do it. If I get it wrong, then I'm done with the system. I can't. It's not that I can't get my document notarized. You just can't get your document notarized with a remote online notarization. That's for safety and security. We want to make sure you are who you say you are. So let's go through this and see what happens. Hopefully I can get these right. So you'll see that they cheated for me and they gave me correct here. That is not, clearly that is not on there when you're going through this as a real signer, but this for demo purposes, they gave me correct, so I did not mess this up. In the bottom left corner, you can see it tells me how much time I have remaining as I'm going through these questions. Once I feel like I have all the questions correct, I've checked my time, I'm going to submit. And I've successfully passed my KBA. So now we're going to move on to credential analysis. How we do that is we use a government issued ID, and we're going to take pictures of it. Today I'm going to use my business card. Again, no offense, you probably don't need to have my driver's license information. So you can do that one of 2 ways. You can do it through your mobile device, or you can do it through your web browser. Today, I'm going to use the web browser. And I'm going to use my fake driver's license. I'm going to take a picture, press any key. Looks pretty good. We're going to confirm and continue. We're going to take a picture of the back. Looks good. Confirm and continue. And then I'm going to enter my driver's license number as it would be on my driver's license or the ID that I provided. All of the other information looks correct here. Then you'll be prompted for a second form of ID. This document does not require a second form of ID, so we will move on. So here's the part where we're going to start bringing Jackie into the process, and it gives you an idea of the costs that you're about to be associated with remote online notarization. Just so you know, the national standard is $25 for notarization, and that is split between the technology platform as well as the notary, so that a notary can build their business. So now we can get started. On average, the wait time to connect with the notary is less than a minute. And as I hit connect, I want to make sure that there aren't any questions before I move forward. Okay. Make sure I mute myself.
All right, so now we're in the part where the notary and the signer are meeting each other. So you can see me, the notary on the top, the signer there below. And we're going to walk the signer on filling out their portion of the document. So I'm going to kind of switch a little bit because I do want you to see, I can use a pointer on me as the notary that will also show up there for the signer, so I can direct their attention to any part of the document. So at that blue dot, I'm going to go ahead and ask Nicole to choose signature there on the top left hand of the screen. She's going to be able to choose that, drag it to where she's going to place the signature on the document. And I'm going to have her create a new signature. I'm going to walk you through. The signer has the ability to have two signature choices, a text-based signature, a handwritten signature. For this demonstration, we're going to go ahead and use that text-based signature. The signer will then have 5 choices of signature. Most of our signers says, I like these a lot better than mine. So Nicole will choose her signature. And I'd like to point out here that the signer does have a disclaimer that they're agreeing that this electronic signature is just as binding as their pen and ink signature. So Nicole's going to go ahead, click agree, and create and apply. This will now have her signature on the document. So at this point, the signer has completed their portion, and you're going to see me switch my screen after Nicole goes ahead and she's going to stop sharing. And here we are. The tooling for the notary is a lot more intensive because I'm doing a lot more adding to the document if necessary. So I want to point out here on the top left hand of the screen, right under the signer's view, it switches to the signer being on top. There's a yellow exclamation point. This is reminding the notary that I need to perform credential analysis. So this is the part that you are. So here's the ID that Nicole uploaded for me to review. I'm going to check here to make sure that it was a driver's license, the name matched, and also that the date of birth matched. If any of those information did not match, it's probably not the signer that needs to be here. I, as a notary, would terminate the call, and then I would have the signer come back through with either the correct person that needs to sign the document or the correct ID. After I've done that, I'm going to be able to look at the back and the front of the ID to make sure that it's a valid ID, and then I'm going to complete that ID validation. Notice that the check mark now goes from an exclamation point to a green check mark. I am now able to complete my notarization on the document. So I'm going to use some of the tooling that I have here to add all the information. The notary is then prompted when they're adding that annotation to the tooling, what kind of notarial language that they're using. This allows to generate the journal that the notary has to do for an electronic notarization. For this example, it is a jurat. I'm going to be able to drag all the information that I need onto the document. So give me one moment while I get that done. And there's my signature. I don't need my commission number or expiration date. I'm also able to drag today's date and my signer's name onto the document. Here is my disclaimer, letting anyone know that this document has been done by audio video communication. There is also a script that the signer and the notary can go through, and I'm going to go through that now. Hello, I'm Jacqueline Phillips. I'm a commissioned notary in the state of Texas for today, and I'd like to let you know that today's audio video session will be recorded. Do you agree?
I agree.
All right. Another part of this is also that we have the signer state their name for the record. So could you please state your name for the record?
Nicole Booth.
Are you participating in today's notarization of your own free will?
I am.
And do you consent in engaging in an electronic transaction today using your electronic signature as your binding signature in these documents?
Yes.
So this is all captured in the audio video requirement that the states have in order to know that who the signer is performing this notarization before the signer, and also that they are legally binding themselves to this notarization. This document also requires an oath. So this is also captured on the video. So I'm going to go ahead and perform that oath. Could you please raise your right hand? Do you solemnly swear or affirm under the penalties of perjury that any statements made by you in these documents are true and correct to the best of your knowledge and belief? Do you swear or affirm?
I affirm.
All right. So this part is now done. I'm going to go ahead and I'm going to lock my document. The notary has now legally done their X509 digital, attached their X509 digital certificate to the document. And the notarization is complete. Like I said, I've locked the document, and this allows for any kind of technology hiccups. I am now going to complete this session. It's going to prompt me to make sure that I'm ready to complete it. And now I'm going to move this back to Nicole for the signer experience.
So something worth noting is that in that audio video recording, we're only recording the talking heads. We're not recording the sensitive information within the document, only the talking heads to ensure that the person who says they are. And that's for a couple of reasons. One is to watch for duress and assist the notary in that piece, as well as for follow-up in case anything happens. Fraudsters don't like to be recorded on camera, so we like to lead with that. So we missed the survey portion of the discussion, but I think that's okay. Jackie did an excellent job. I would have given her 5 stars. So now we're to the end. My document has been uploaded already. You can see it here on the right side of the website. I can email it to whoever I need. I can come back and check on it. I can open it at any time and within the Notarize portal. So a few things that I just wanted to highlight that you always have access to in our portal is, again, you can see the document here. You can go to this piece. It tells me what document it was, when it was completed. That audio video recording takes a few minutes to process. Otherwise, that is available for you as well. You will see that it is only the talking heads going back and forth. And then you can see the type of notarial act that was completed, who completed it, their commission number, the platform, as well that it was completed. And then lastly, the last piece is a summary of what I paid and my access PIN within Notarize and the status. And that is it. It took a little bit longer, but we wanted to make sure we walked through each step. Do you have any questions for us?
All right, are there any questions? Any comments? All right, if there are no questions or comments, I want to thank you, you ladies, for your presentation.
Thank you for
Very
having
interesting.
us.
And we'll move on to the next topic, which is topic number 4, the update and review on the state insurance regulatory sandboxes. And joining us today, we have Reese Empey, Director of State Government Affairs for Libertas Institute, and Kevin Gaffney, Deputy Commissioner of Insurance, Vermont Department of Financial Regulations. Before starting with the speakers, I want to first note that in your binders for your reference during this discussion, starting on page 261, is a copy of Vermont's Insurance Sandbox Enabling Statute, following by a copy of Utah's. So now I'd like to recognize my colleague from Kentucky, Representative Bart Rowland, for brief comments.
Thank you, Mr. Chairman, and I'll be very brief this morning. Before we hear from Reese and Kevin, I'd just like to note that my home state of Kentucky also has an insurance regulatory sandbox that has been in effect since 2019. I obviously support the concept of insurance regulatory sandboxes, and as you'll hear from the speakers today, the main goal of such sandboxes is to reduce regulatory hurdles for companies that want to introduce new concepts and products at the same speed as insurance technology develops. So before moving forward with any sort of NCOIL model language related to the sandboxes, I'm interested to hear from our speakers today and their thoughts on what a potential model might look like. So look forward to hearing from you. Thank you, Mr. Chairman.
Thank you.
We good to start?
The floor is yours.
Hello, thank you all for coming out to Boston and for inviting me to speak. I'm grateful to be here. My name is Reese Empey, and I'm the Director of State Government Affairs at Libertas Institute, a nonprofit think tank based in Utah. While Libertas works on a range of issues in Utah, my role is to bring policies we've helped usher through the Utah State Legislature to other states. One of these, and my biggest priority, is the concept of a regulatory sandbox, while also supporting the existing ones, such as Kentucky and Vermont's insurance sandboxes. Now imagine you've just graduated from college and you're ready to make some money, but your degree isn't helping you out as much as you were hoping. I'm sure that most of you know someone that is struggling with this, or maybe some of you even went through this. But imagine how different life would be for a postgraduate student if their earnings were secured for the first 5 years after graduation. In other words, Degree Insurance, which is a company based not even 5 minutes from Libertas' office, is an innovative company that will cut a check for the student if that student's income fails to reach the average earnings for that particular degree, whatever that degree may be. Degree Insurance is licensed to operate in Utah, South Dakota, North Dakota, Illinois, and Arizona, but frequently runs into issues with other states' insurance departments due to things like seasoning requirements or not neatly fitting within the typical insurance mold. That's because prior to Degree Insurance, nobody has pursued an insurance product such as this. And Degree Insurance is but one example of an innovative insurance product and serves as proof as to why regulatory sandboxes can be so helpful in the insurance space as well as many others. Now, I should note that Degree Insurance is not a sandbox participant in any of those states, but the sandbox in South Dakota did attract them there, for example. Now, in short, sandboxes enable innovators, businesses both big and small, to work with regulators and legislators in trialing new products, services, and business models while regulations inapplicable to their idea are temporarily waived. States can pursue an industry-targeted sandbox, which highlights specific industries to allow for this temporary regulatory relief. Utah and West Virginia's insurance sandboxes are good examples. On the other hand, states can also pursue an all-inclusive sandbox, which opens the door for any and all companies, regardless of industry, to apply for temporary regulatory relief, which Utah unanimously adopted this year. This sandbox concept originated in 2014 when the United Kingdom launched the world's first sandbox and targeted financial technologies or fintech companies. Shortly after, countries such as Australia, Singapore, Hong Kong, and several others implemented sandboxes of their own while expanding the concept's application to other industries. Stateside in 2018, Arizona passed America's first sandbox, which targeted fintech companies. Following Arizona's lead, states such as Utah, Vermont, Kentucky, Florida, California, Hawaii, West Virginia, Wyoming, and South Dakota began implementing their own, while states like New York and North Carolina are actively considering them. At Libertas, we love sandboxes because it invites the business community to the table so they can highlight troublesome regulations while working with regulators and legislators to update the state's regulatory code to better welcome the innovations of tomorrow. And in addition, with multiple states running sandboxes, businesses are able to scale up and offer their product across several sandbox states rather than just one or two. A lot of folks are worried about bad actors, and I don't blame them, but consumer protection is offered from the very beginning with the application process and throughout the trial period, which is typically 2 years max. Businesses trialing their product in the sandbox are supervised by regulators, while ideas that will obviously bring harm to consumers are barred from entry. And as the sandboxes operate, it'll help the state legislature identify and update outdated regulations by providing real examples of those regulations not working as intended. Now, these revisions and funding for the sandbox program itself can't happen without the state legislature. The regulatory waivers are only temporary, and the regulators overseeing these businesses in the sandbox recommend reforms to the legislature based on what they're seeing when those regulations are waived. And in the end, the sandbox concept strives to allow for its participants to enter the full marketplace once their trial period ends and offer their products to any and all consumers rather than the typical cap of 10,000 consumers within the sandbox. Now in Utah, our sandboxes are still mostly getting off the ground. While Utah hosts a fintech, legal services, insurance, and all-inclusive sandbox, I want to narrow in on our insurance sandbox. In 2020, Utah State Representative Adam Robertson sponsored House Bill 402, which established Utah's insurance sandbox. HB 402 passed the Utah State House of Representatives with 58 yay votes and 11 nay votes. And over in the Senate, HB 402 passed with 27 yay votes and 1 nay vote. After receiving both Republican and Democratic support in the legislature, HB 402 received the governor's signature. Then the program launched right as COVID hit. And as many of you know, it changed day-to-day life for almost everyone. However, we're hopeful it'll take off as more states in the Mountain West and frankly, the entire country begin to consider and adopt a similar sandbox, which will appeal to the insurance industry's trend of offering their products regionally. West Virginia, South Dakota, Louisiana, and North Carolina are good examples just from this year. Overall, sandboxes provide opportunities for creative minds to trial their new and innovative products while providing regulators and legislators with real examples of regulations not neatly working in today's innovative world. Also, rather than a startup spending thousands of dollars on lawsuits and lobbyists to change the law to accommodate them, which not all of them can afford, this offers a more affordable avenue to trial their service. And we cannot begin to imagine the life-changing products and services that may come as a result of this new regulatory framework. Thank you all for having me, and I appreciate your time.
Thank you. Kevin Gaffney, Deputy Commissioner of Insurance. Oh, sorry. Do you want to take questions now?
No, continue.
Okay. I think my slides are up on the, okay, there they are. Deputy Commissioner of Insurance at the Vermont Department of Financial Regulation. I guess it's Vermont Day. Vermont was the second state behind Kentucky to implement an insurance regulatory sandbox. That sandbox was put in place through Act 57 in 2019. And just to give a brief overview of the concept, I think you've heard it from Reese, but it's a commissioner granting a waiver of either a law, a regulation, or bulletin that would prohibit either more efficiencies or innovation in the marketplace. It would also still maintain whatever the public policy goals of the law, regulation, or bulletin attempted to achieve or by another means. And the waiver would not substantially increase the risk to consumers. And obviously the waiver would be in the public interest. So that's all part of the application process. A waiver may be granted for up to 12 months, and within the 12-month waiver period, an extension of additional 12 months can be requested. The consumer protection piece in Vermont, we have the limit of 10,000 customers for any product or service being delivered to Vermonters. There's also mandatory disclosure requirements. This was something that the legislature was very supportive of, and as was the commissioner, in making sure that a purchaser of a product or service through a waiver was aware of who the participant was in the market, that the product and service and the innovation was temporary, and that there was an end of the waiver period, and obviously contact to our department should the consumer have any questions or inquiries or complaints. And then the consumer must give, the commissioner must give a public notice period. So when the applicant applies for the waiver then is posted on the department's website, and there's a time frame to offer public comment. There's financial requirements as part of the sandbox. There's statutory deposit requirements. By regulation, the amount is no less than 10,000, but it's commensurate with the risk of the product or service being provided. The participant must provide 60 days prior notice of the effective date of the waiver with an estimate of the total premium and claims anticipated during the waiver period. And that amount may be increased or decreased during the time frame should the commissioner determine that the risk profile has changed during the waiver period. You know, there's a distinction between issuing a license to a company and having them do business and the level of monitoring that the sandbox requires. So there's additional monitoring within the sandbox regime that requires quarterly monitoring of the policies written, the premium, dollars, and claims dollars, and any material changes in business plans, underwriting, and claims practice. So this provides a little more detailed insight to your state regulators on what is actually happening with the sandbox participant. And to evaluate the compliance with the conditions of the waiver, the commissioner has broader authority to examine further any transactions, accounts, or records as the commissioner does generally under our examination authority. There are a number of provisions that are not subject to the waiver. So obviously capital and surplus requirements, taxes and fees, any regulation that's an NAIC accreditation requirement, health insurance, guarantee association, workers' compensation, insurance trade practices, licensing requirements, and long-term care insurance. Now, as you as regulators consider legislation in your states, these are items that you may or may not look at differently. You know, we didn't have the foresight when we did this legislation of what came about 70 days after the regulation was promulgated, which was the pandemic. So there's, you know, I can see, you know, workers' compensation, there'd be an opportunity for innovation in that space. I think the gig economy was emerging rapidly pre-pandemic. I think it's going to emerge even more post-pandemic. So I think there's a number of innovative ways to deliver perhaps insurance products that we didn't consider at the time because there was a level of conservancy to offer that in the sandbox. What happens at the expiration of the waiver period? The participant shall cease all activities that were permitted through the waiver and comply with all the generally applicable laws. There's biennial reporting to the legislature, the total number of, by the commissioner. We have to provide details on the petitions for waiver, how many we received, how many were granted, and how many were denied. Waivers that have lapsed or been revoked or any disciplinary action imposed, and a list of regulations or bulletins that have been adopted or amended as a result or in connection with the waiver. And lastly, with respect to statutes to which waivers apply, the commissioner may make recommendations as to whether such statutes should be continued, eliminated, or amended in order to promote innovation and establish a uniform regulatory system for all regulated entities. So the legislative process, I touched on it briefly. We passed Act 57 in 2019. There certainly were some concerns about giving the commissioner discretion to waive the laws, but I think if you look at the structure of the sandbox, there's a lot of monitoring and control to protect consumers. Those robust consumer protections were important to both the commissioner and the legislature. Originally, no waivers could be granted until after July 1, 2021, which would make this discussion moot. So in the past legislative session, due to the pandemic, the legislature enacted a 2-year extension of both the new application deadline and the sunset of the law. So the law now sunsets on July 1, 2025, and new applications can be received no later than July 1, 2023. We have not yet received applications. I think, in part, both regulators and industry had to react to in the last 17 months to the pandemic. Certainly as regulators, we enacted many emergency rules that industry had to respond to protect consumers and to deliver the service that best served the public. So their attention could have been taken away from the innovative initiatives. I also think it's an opportunity always to just interact with the tech community. They're not necessarily insurance folks. They may have the concept and they may be contracting with an incumbent insurer to deliver some innovative service. But what I'd like to express is that the department is always open to hearing about innovative ideas, and we do anticipate that the greater need for products and services. And a lot of times you'll hear the perspective from the innovators, but I also think consumer demand and not just the millennial generations and younger, but I think there's just consumer demand across the board for products to be delivered in a different way, in a more efficient way, also to get to areas and markets that we've found through the pandemic have been underserved. So I think the sandbox could offer a lot of different opportunities for your constituents in your states. And lastly, I just have some links to both our regulation. So if you want to look at the details of our regulation. Additionally, we created a portal on our website. So if an applicant wishes to pursue a waiver, they will go and fill out some general information on the website. That's just to initiate the process. That's our way to kind of vet what's coming to us and arrange for further details before an application is submitted. So I just hope that gives you a flavor of what we engaged in legislatively and by regulation in Vermont, and happy to answer any questions.
All right, are there any questions from any legislators?
Yes, Spiros Manzavanos from Delaware. Quick question: have you seen either in Vermont or Utah any need for any costs associated with doing this? Additional regulators that may have expertise for a particular sandbox or anything like that?
It's a good question, and it's something that we have considered. We're fortunate in Vermont to have been able to attract a lot of very strong, experienced regulators. We actually expanded our staff in areas of focus where we see innovative products already in the traditional market, in the already regulated market outside of sandbox. So I think we have capacity to take that on, but the reality is if those numbers grew, we'd have to account for the resources to conduct that work.
Thank you.
All right. Connecticut Representative Stephen Meskis has a question.
Well, so there's a part of me that finds this very exciting, and a part of me that's completely horrified by the structure. So I guess the question on a regulatory framework is, if I'm insuring a product with the legislative structure of a 2-year sunset provision, what's the time frame of the insurance that I'm looking to cover in terms of, or the nature of the coverage is, I can't sell performance on a college degree that requires 4 years to get the degree with a product that has a sunset before I graduate, because obviously we won't know what my salary is going to look like before the insurance license expires. So there's a question about the timeframes of the policies I'd look to underwrite in this new sandbox, the expiry of the law. The second is, when I think about insurance, a lot of it deals with credibility, trust, public confidence. So the participants that are moving into this business, are we looking at licensed, regulated insurance entities that are looking to expand into the sandbox with new innovative products, where we're granting them waivers to test product? or are we bringing in new innovators who may or may not be known to the insurance community or to the regulators of my state? So am I trying to broaden the aspects of my existing insurance companies, or allowing new, which I would say untested players into the market? So I'm trying to measure risk. When I open up the gate to new performers, I want to make sure it's not like we all got involved in energy deregulation and we ended up with Enron. So I want to make sure we're, which road we're going down on this.
Yeah, both. But first, your initial observations on the timing in terms of the sunset. Yeah, I think that's one of the reasons why I wanted to present what we went through, because I think that's a good observation. I think the sunset creates some limitations. So as you look at doing that in your states, you may want to consider that and create and decide what limitations you're creating. Perhaps you could just ask for some kind of report back after a certain period of time to gain comfort to continue with the sandbox rather than a sunset. I mean, pragmatically, we're hopeful that we get some sandbox applications. We show a record of success, and then there'll be a discussion before the expiration of the legislation to perhaps extend the sunset. But I'm not suggesting that I'll have the ability to do that. But I mean, I think the information will provide the documentation, whether it's warranted or not, and ultimately the legislature will have to decide. In terms of incumbents versus innovators, it's both. We see, and I think the application process and the detail that we have in there, the incumbents are very familiar with, right? And they're very comfortable in that space. The innovators may not be, but that doesn't mean, you heard from our captive team just this morning, and certainly there are plenty of consultants and experts that can assist innovators to make sure they can comply with all the actuarial analysis and all the regulatory requirements. So we will, through the regulatory oversight, make sure that we don't approve an applicant that we don't feel comfortable with. So there's an application process to safeguard that. But yeah, I think the observation is good, but I think the opportunity is for both incumbents and innovators.
And lastly, my only concern would be in the institutional framework, you'd want to be very careful on the unwind provision. So if we go to a sunset and there's an unwind and there have been no claims, no claim history, so the product is essentially, you've got your consumer base buying into a product that is represented no insurable value. Is the unwind going back to the shareholders, or is there going to be any restitution or partial restitution to the participants in the market who bought insurance that has had, quote unquote, no loss record?
Well, absent losses doesn't mean absent value. I mean, insurance is a transfer of risk. So when you're under that contract, you have that protection. So should you have a claim, you get that protection. But if you go a year with your auto insurance and don't have a claim, you don't get the money back because it's a risk pooling arrangement. And
but that's a risk pooling arrangement where you're spreading risk among a loss history. We have no loss history. So I want to make sure we're not underwriting product that has no value and charging consumers. So there's kind of a back and forth there when we have no history and innovation. Is it, you want to provide legitimate levels of insurance and coverage and risk perception, make sure that it's not just a fee harvesting arrangement for innovators.
Yeah, absolutely. I think that's our role as regulators too. I mean, I think we're adept enough to understand the difference. There has to be a true risk that exists and a true exposure that exists. So remember in the earlier slide, I mentioned that there has to be a business plan that outlines the policies anticipated to be written, the claims anticipated to be incurred. And we won't just accept those for face value. We'll ask questions about how did they get to that? What's the basis? Are there actuarial they're going to have actuaries kind of weigh in on that and justify that representation. There was another point. Oh, I just want to clarify. I kept saying incumbents and innovators. There's plenty of incumbents that are innovators. So when I say innovators, I think there's innovators in the incumbent space and the non-licensed insurance space.
All right, Representative Rowland.
Thank you, Mr. Chairman. Just a couple of comments and then a question. After passage in 2019 of our sandbox, the Kentucky Department of Insurance had a lot of conversations with folks who thought they needed a sandbox to implement their ideas, only to find out after discussing with our department that they were able to find a way under current insurance statute or regulation to operate. So to date, we've not successfully completed an application in Kentucky, but we have had a lot of conversations, the department tells me, and then also there's discussion that Kentucky itself as a market may be too small for some of these innovators to come in and really implement their idea. There's just not enough market for Kentucky by itself. So potentially, if we do implement a model and some of our contiguous states implement it, then maybe at that time the market becomes large enough for some of these innovators to operate in. But I guess my question for Reese and Kevin is, we've had several states now that do have a regulatory sandbox. Do you know of any state that has successfully granted a waiver under their sandbox?
Utah's insurance sandbox, if our memory serves correctly, has run into a similar problem where innovators mistakenly thought that they couldn't operate before the sandbox. And to add on to that, I think a lot of the new insurance sandbox programs, such as West Virginia, South Dakota, which recently came into the fold of Utah, Vermont, and Kentucky, I think it's just too new. I think it's going to take some more time and some more states to adopt, especially kind of in the region of Kentucky and Utah and Vermont, for us to really see action. So it's more regional.
I haven't seen any, waivers granted, but that doesn't mean there haven't been. I'd have to check in with my fellow regulators. I do think that there are some regulators that feel they already have the authority to do this without a sandbox. I mean, I think you could argue that if you look at the current insurance laws and the discretion of the commissioner. But I think when we really established the sandbox, I don't know if that was the case in Kentucky, we felt that it was a much more transparent process to kind of lay out the landscape. Consumers could be fully aware of what's coming and all the disclosures that come with it. So we felt the sandbox was the right approach. I think now it's just time will tell whether we have the right balance in terms of the structure of the sandbox. Are there, if there are barriers that are in the sandbox regime, we'd like to hear from the innovators, and we certainly will react to those and maybe re-engage with the legislature on those.
Yeah, thank you. Well, I believe it was positive in Kentucky. It at least did create some conversation between these innovators and our Department of Insurance. And the entire time we were debating in Kentucky, I felt like the biggest opportunity was not new insurance companies and new insurance products, but it was all the back office support that goes into selling, servicing, or handling claims for our current insurance. I think for our current insurance companies who are operating in Kentucky, I think that's the real opportunity, that some of these folks will think of some product to help support our existing insurance industry.
I'll just add, we talk about risk transfer and the like, but I also see the opportunity for risk mitigation. A lot of insurance, the insurance industry is looking at not just assuming risk, but also looking at ways to mitigate loss and to offer either wellness or other types of loss mitigators. And I think there's a lot of innovation in that space. And certainly those provide some really strong benefits to consumers.
All right, Representative Ferguson.
Thank you. If the goal of the sandbox really is to encourage IT and innovation, obviously, if not many states are getting takers for the waiver, are there any states offering additional incentives for this innovation, like tax credits or other things for these companies to get started?
Personally, I think the temporary regulatory relief is a good way to attract them. And I think a big problem is a lot of folks just aren't aware of these sandboxes. And that's part of my role at Libertas Institute, is to try and increase that awareness so folks know that they can take advantage of these sandboxes across the country.
And I know you said Utah didn't just do it for insurance. Are you finding more interest in the fintech or other areas, or is it? I know we're insurance council, but where are you finding the most interest? Is it in insurance or fintech or the other things?
Our fintech sandbox and our insurance sandbox have not had any successful applicants. You know, they thought that they couldn't operate before the sandbox, and they found out they actually could. However, our legal services sandbox, which is run by our state Supreme Court, currently hosts over 30 entrepreneurs trialing new products, different ways to run a law firm. And then our all-inclusive sandbox, which just passed this last legislative session, is set to go online next month and has received a lot of interest from folks of all sorts of backgrounds and industries.
And I guess, yeah, I just would add that I don't think Vermont would want to move away from the discipline we've established in the sandbox with incentives. I think you kind of heard that a little bit in the discussion earlier with captives and the tax code. And, you know, the first and foremost, it's an insurance product. If somebody wants to come to market with an insurance product, they have to kind of follow the regulatory regime and meet that discipline. You know, we welcome innovation, but within the regime of insurance regulation.
All right, Representative Newchild.
Hi, good morning. How are you? So my expertise is definitely in the healthcare arena, and I have a few questions. I'm thinking of this, as you said, you know, if you're an incumbent and you're not innovating, you're dying. So I see this as an opportunity not only for incumbents, but for new innovators. And a few of the questions that I was writing down as you were talking about this. So if I selectively pick a regulation that I think is impairing my ability to come to market with a new product, how is the risk determined for the consumer in relation to that singularity regulation? Who's determining that risk?
Yeah, so I think part of the process is that business plan. So it's the anticipated claims that will come with that. So I you know, without knowing specifically what regulation or law you're talking about, it would be hard to assess. But I think that's why, if you look at the provisions not part of the waiver, a lot of the insurance trade practices laws are not, because we just feel like none of those can be compromised, and those would present some difficult situations for consumers. You know, it would just depend on what specifically was being waived and how to assess that. But a lot of times it's not necessarily something that enhances risk necessarily, but just changes process. I'll give you just a simple example. You know, policies are typically in the property and casualty side are a 12-month policy, but you know, that regime has changed quite a bit. Now they can be, you know, monthly or hourly. But then how do you do cancellation provisions that are 45 days? So you'd have to waive those cancellation provisions to be able to deliver those products. We don't really see that necessarily increasing the risk. It's just, how do you deliver that? In what way? Now electronically, most likely on a cell phone, and it's an opt-in for the consumer. So, you know, it's more about probably process than enhanced risk.
That kind of led me right to my second question, which is for the states that have implemented something like this, what are the types of regulations that are being asked to be waived?
Yeah, I wish I could give you a whole list, but we don't have any applicants right now.
Okay.
But maybe the next time we talk, I'll have more examples.
That'd be good. So I'm again thinking of the sunset date in the 2 years, depending on the type of insurance and the specific regulation you're looking to waive that is being found to be cumbersome, especially with an emerging market or trying a new development of a new product. 2 years, depending on the type of insurance, might not be enough to truly establish any kind of in-depth knowledge or trend to be able to say, if we remove this regulation across the board, we're going to see A, B, C, or D. So I think there's some concern around the sunset in relation to the type of service, the type of provider, the type of insurance, and also the type of product that they're looking to innovate. You know, you might need more flexibility around, I need 5 years to see if this is going to create a positive trend, or if it's going to have an initial good spike and then it's going to tank in 3 years from that. So the sunset date being a hard and fast is a little concerning for me. And lastly, again, from a health insurance perspective, I'm thinking of how many times in industry we see new products, new markets, ways to be able to specialize in certain areas. And I got to thinking about a 10,000 member limit. You could really focus in on a national account who has several thousand, and create a market-driven specific thing if there's a regulation that is impairing innovation in that network. But that would then have the possibility of crossing over state lines. So the sandbox, if I'm hearing you correctly, would be state specific. So you would need to either find a conglomeration of accounts that equaled up to the 10,000, or a national account that happened to have a large headquarters or base in one area with a $10,000 member max. Is that what you're thinking this is going to help with? Are you seeing this as more smaller members pulled together, or more of a national model where you have a combined membership?
Well, I'll take it from the insurance, and if Reese wants to add, just, conceptually, but, the basis for the sandbox is to kind of test out a new idea, not necessarily go kind of to a full broad market. I was hearing some discussion the last few days about, there were some workers' comp discussions yesterday, and about data, well, we'd like to see the data so we can decide as legislators how to go about making a decision. We don't really want to change that law because we don't see the data to support the change. The sandbox is that, right? The sandbox now gives you that opportunity to kind of test something out, maybe see some results, and then decide at the end of that period whether some minor revision to the regulation or law is required. So it's kind of a catch-22. Yeah, would 5 years or 10 years be a more robust period of time? Yes, but you wouldn't want to waive, I think, a regulation or law for any extended period of time before you kind of make an evaluation of, do you then have to convert from the sandbox regime into a traditional regime? And just specifically, we don't, in Vermont, the waiver does not apply to healthcare. And I think for some of the things you're touching on now, we just didn't feel that healthcare was the right fit. We may be missing the mark there, but at least our initial view is that it just won't work based on what we understand the needs of the healthcare consumer are.
That's interesting. It's definitely interesting because I think healthcare is probably one of the biggest areas of insurance that we need to understand and be able to drive. It's probably one of the biggest concerns of the American people across the country is healthcare costs. So being able to find innovative ways to do that and to understand the regulatory impact. But I think it just kind of all loops me back to, again, regardless of the insurance type that we're looking at, is each regulation, how do we determine that risk, and not taking sole information just from an insurance company, but being able to actually gauge the risk to that 10,000 people. So thank you very much for your answers.
If I may address your point about across the state lines, I think that's why having reciprocity agreement language within the sandbox language is so important, which is something we started to see with the fintech sandboxes. For example, West Virginia just made an amendment to their fintech sandbox to add reciprocity agreements so that West Virginia's fintech sandbox can talk to Wyoming's, Utah's, Arizona's. And I think something like along those lines could happen within the insurance sandbox space as well. And I think it'd be a great thing.
As we're approaching 9:30, we got one other brief comment, and then we need to wrap it up. But Representative, you had a follow-up comment?
No, you're all set, Mr. Chairman.
All right. I think we have one other brief comment. JP Weisky.
Yes, hi, my name is JP Weisky. I'm the former Deputy Commissioner in Wisconsin, representing the American InsurTech Council. Would note that in my position in Wisconsin, we did have a similar regulatory sandbox. The law actually dates back to the 1970s that allows the commissioner to waive any insurance law with a hearing and a finding. Just for note, we did go through a number of these processes with a number of companies inside Wisconsin that came in, and in a very similar approach, A lot of the waivers, similar to what was discussed, we did find similar to other states that in a lot of cases, there's nothing that needs to be waived. In a lot of cases, though, there are filing issues inside departments from a timing perspective, and they need to be able to adjust the filings very fast. And so there's staff, as Vermont has indicated, you need some staffing issues and some other pieces that go along with that. We had a number of successful products that went through. We had private agreements with the insurers to, in fact, return premium in certain cases. If the policies were never going to pay out, the expectation is the consumer can't know the money's going back, right? Because that messes up the whole experiment. But they had an agreement behind the scenes with us to be able to return the premium net of claims following the piece. So there are a number of initiatives we went through, but the biggest thing we saw was the ability to make changes in new product filings and to make them very quickly and to make adjustments based on specifics. You may have heard ads for a product sold across the country by an insurance company sold to landlords pre-COVID. I don't know if they sold it post-COVID, that would cover people, their renters, in case they lost their jobs. That was something that went through our process and was ultimately launched. There are several others that went through that process as well, but there is a lot of successful innovation that could happen as a result of this. So I think it's something that states should take a look at. So thank you.
Thank you. I want to thank all the panelists for the information, and just note that we may discuss this topic again in our November meeting. So thank you again. Do we have any other business? Hearing none, I entertain a motion for adjournment.
Sorry, I don't know why I gave you knuckles.
So move.
Second.
Second.
All in favor?
Aye.
Opposed? Meeting is adjourned. Thank you so much.
All right. We will call this NAIC NCOIL dialogue meeting to order. And I will first ask lawmakers on the call, on the Zoom call, to identify themselves. I, of course, am Ken Cooley out in California.
Senator Jim Gooch from Kentucky.
Thank you. Other lawmakers on Zoom? Hearing none, I'll ask lawmakers in the room to identify themselves.
Representative Lehman from Indiana, and I'll start down here to my right on the far end, and we'll just work our way around this way.
Thank you.
Thank you. Senator Mary Felskowski, Wisconsin.
Wendy Thomas, representative from Pennsylvania.
Brenda Carter, representative from Michigan.
Assemblymember Hunter from New York.
Representative Joe Fisher from Kentucky.
Senator Matt Pitch, Arkansas.
Senator Keith Ingram, Arkansas.
Representative Tammy Nuccio, Connecticut.
State Senator Randy Burkhardt from North Dakota.
Senator Jerry Klein, North Dakota.
Senator Paul Etke, Minnesota.
Senator Travis Holdman, Indiana.
All right, Mr. Chairman, that is the room, and it's really exciting to have this big of a group, and I'll turn it back to you for introductions of the commissioners.
Very good. And staff, do we have a quorum, or do I need a motion to waive the quorum?
Second.
I did
We
not
have a
hear.
second here, Mr. Chairman.
Well, was there a motion?
Yes.
Okay. All those in favor, please say aye. Opposed, nay. Then the quorum is waived. Also, can I get a motion to adopt the April 16th, 2021 committee meeting minutes?
So moved.
I hear motion, second. Seconded.
Second.
All in favor, please say aye.
Aye.
Opposed? Then the minutes are duly adopted. Today, the agenda is on page 283 in the conference binder. And I want to welcome our attendees. I'm going to start with, we have Dean Cameron with us from Idaho. So welcome, President-elect of the NAIC, Cameron. Thank you for coming back and joining us again. We also have Oklahoma Insurance Commissioner Glenn Mulready. Thank you again, Glenn, for joining us again. And the great state of Mississippi, Insurance Commissioner Mike Cheney with us. Any other commissioners that are joining us today?
Mr. Chairman, Director Dana Pulper-Severinghouse from Illinois was scheduled to join us today, but she had a blessed event and became a new mother, and so that takes precedence over this dialogue as much as we view this dialogue as critical. So God bless her and her new baby.
Oh,
She
very
needs to get her
fantastic.
priorities straight.
Oh, very good. Okay, then we might as well just jump in. Again, thank you all for this very important tradition of ours. I also note from the chat that Chris Haas of the great state of Delaware, I believe that was, he's a designee for Insurance Commissioner Trinidad Navarro of Delaware, is joining us for this meeting. So Chris, thank you for being here and making your presence known. I want to start, we're going to depart from the formal agenda and move to item 7B, the No Surprises Act, for just a brief excursion as we start out. One of the main issues addressed by the Federal No Surprises Act is the issue of balanced billing. And those who are regular attendees at NCOIL know that in 2017, we adopted our out-of-network balanced billing transparency model act. And I'm interested in getting some comments on how the implementation of these balanced billing laws are going. Commissioner Cheney, do you have some observations as the status of balanced billing of consumers in the wake of the NCOIL's adoption of the Model Act and of course the Federal No Surprises Act?
Assemblyman Cooley, this is Director Cameron speaking, and just before we go to Commissioner Cheney and Mulready, just first of all, we wanted to thank NCOIL for the opportunity to be with you and to present with you I wanted to call him Congressman Lehman, but Representative Lehman.
He has a certain dignity.
Yeah. Representative Lehman said to me earlier, it's kind of unique. The three of us that are here are former state legislators, have walked in your shoes and know the difficult choices that you have to make. In fact, I was commenting my wife got me cleaning out some stuff, and I was going through a box and I found an NCOIL badge and brochure from when I attended NCOIL maybe 15 years ago or 11 years ago or something here in Boston, actually. So interesting time, and we're grateful for the opportunity to be with you and look forward to continued and improved relationships with NCOIL as we move forward on some very difficult issues. We had kind of divided up some of the issues you had requested amongst ourselves, and I think Commissioner Mulready was going to go first on the No Surprises Act, but certainly you asked a direct question of Commissioner Cheney, so if he wants to respond to that, that's great.
If there is a response from Representative Cheney, of course, and then to Glenn.
Thank you, Mr. Chairman. I would reiterate what Commissioner Cameron said. We're pleased to be here at NCOIL and to have an open dialogue. Very briefly, I will just say on the No Surprise Billing Act, our state has always had a law in the books, not always, but a law in the books longstanding that said if a consumer assigned their health benefits to a healthcare provider, that you could not balance bill if they were in the network. And within the last 2 years, we strengthened that law to give the commissioners some regulatory authority to enforce balanced billing. And of course, if you go to the hospital and you assign your benefits and they're not in the network, then the payment would be at an out-of-network rate. We have basically used this to prevent balance billing in emergency rooms where you have a provider that's on contract and they get a $8,000 or $9,000 surprise bill 2 weeks after a mother is taking a child into the emergency room at 2 o'clock in the morning. It's worked very well to prevent balance billing and protect the consumers. And then we've also used this particular enforcement against air ambulances. We've had instances where air ambulances would go and pick someone up 10 miles from the hospital off the interstate and fly them in, and the insurance carrier may pay $15,000, $16,000 depending upon how far the flight was, which is a normal payment, and then the consumer would get a $50,000 or $60,000 bill 3 or 4 weeks later. And that's not just in my state, in Mississippi, it's common in a lot of states. So we took the position that we did regulate to some degree the medical providers on that aircraft, and the air ambulances had to prove that it actually cost them $50,000 for 45 minutes of flight. So we've been able to keep that genie in the bottle, and I'm pleased to say in 4 years we've not lost a single case. That may not hold true in the future, but so far we're batting fairly well without having to go to court. We're a little different from the states like Montana and North Dakota where they have a lot of rural areas. So I'm going to let Commissioner Mulready talk about some of the issues they have in Oklahoma concerning balance billing. Glenn?
Thank you very much.
Thank you, Mike. Assemblyman, I can't add some comments without letting you know that I almost didn't recognize you on the screen without your shower curtain backdrop.
There you go, right, yeah.
Sorry.
Maybe he's painted that shower curtain.
Yeah.
Okay. Couldn't resist, sorry.
Right.
So just a couple things. I'll talk specifically about Oklahoma, where we, as everyone knows, some states have passed their own state regulation and or the state laws, and some have not. In our state of Oklahoma, we tried for a couple of years and just weren't able to get something pushed through. I've jokingly mentioned that I felt like I was beating my head against the wall for a couple of years there. But at any rate, then the federal legislation came along. But of course, the importance of the federal legislation was that it was to supplement and not take the place of anything that any of the individual states have done. And it will just supplement that. But it does supplement it in some very important areas like the ERISA plans, self-insured plans, and air ambulance, as Commissioner Cheney just mentioned. You know, in the law, it required this definition of geographic areas. Input was sought from the NEIC, and we gave our input, but they ultimately did not take that, and they decided instead of the geographic areas currently used for the ACA plans within the state for pricing purposes, that they did a definition using MSAs instead. So there'll be fewer areas and fewer payment amounts. We'll see what happens there. There was a survey that's gone out to all regulators. In fact, I believe that was the due date was yesterday. Am I on the 16th? Kind of lost track of with meetings. So that was due yesterday. And you know, there are a lot of states like ours when we're being asked the question about who regulates provider billing in your state, and you'd be on some conference calls and hear some crickets on that because a lot of them are not authorized to do that. So there are many states, including ours, who need to take some action on that, or it will just revert to the feds to fulfill the enforcement on that. There is some feedback and additional space for comment that I believe is due on September 7th. I might even just read a few things. And by reading those, this is just feedback that we've received that will probably be included in our comments to them. So number one, needing a clear definition of covered services to prevent carriers from using provider exclusions, tiered networks, or other language to limit protections for consumers. specify, as I stated, the authority of the states to enforce the air ambulance provisions to avoid any challenges under the Airline Deregulation Act. We're suggesting we need flexibilities for the states to define geographic areas, since, as I mentioned earlier, they're using a different definition than we had recommended to begin with. Need funding for the states to enforce those federal laws. There's currently no funding provided at all for this as well. Clarification on how more protective state laws might play out, especially in the areas of disclosures where states don't allow waiver protections, making sure those are preserved. And then needing more information on how state and federal oversight will be coordinated with complaints that are filed. We have this, potential collaborative agreement with the feds, but that they've talked about, but there's no detail to that. So what would that look like? We don't really know that at this point. So that's about it for feedback from us on what's happening with the No Surprises Act. It's playing out. NEIC is giving their feedback and comments for September 7th.
Yeah. The point you make on the geographic regions is sort of a theme. As state regulators, do you have an undercurrent of worry that you have at the federal level in various areas, entities jumping into the insurance space and not actually understanding how state-based regulation has worked, the role of the regulators, the resources, the systematic way you've sought to undertake your responsibilities, and not understanding the logic to your approach to issues at the state level, wanting to reinvent the wheel?
If I heard you correctly, Assemblyman, I think that's the concern of the NEIC is on that definition. It just shrinks it down too much. And when you're talking about paying a fair, in quotes, fair reimbursement level, we believe that the better approach was what was suggested and utilizing the pricing areas within under the ACA. So I'm not sure if that answers your exact question, but.
No, that's very responsive. It's just a question of, they're sort of introducing their take on how to solve these things and not necessarily listening to the regulator.
So under the ACA, most states were required to have geographic districts, and that's for billing purposes. And NEIC kind of took the position that, and CMS has told us that they must consult with NEIC on the definition of geographic areas. And the NEIC recommended using the geographic areas that already exist, and they use vicarious within the various states under the ACA, the Affordable Care Act. So for premium pricing purposes, for consistency and alignments with premium. So it's out there. We just think that the state should be able to regulate it. Like you say, Assemblyman Cooley, we're in your corner on that. Just let me say that.
Yeah. Thank you very much, Representative Cheney. So now we're going to turn to the portion of our agenda, the ESG issues, environmental, social, and governance issues. That, of course, has become kind of a very important new acronym across the entire government business sector. And it is remarkable what we've been seeing happening on the climate front and resilience. Can you provide some update on the climate subject? And I'm sorry, I dropped. Have I lost?
No, Ken, can you repeat that, Ken? You're a little bit hard to understand. I know we lost the shower curtain, but it still sounds like you're sitting in a bathtub.
On the ESG, well, pardon me. Why don't we start with the NAIC Special Committee on Race and Insurance under the ESG topic? So you're not hearing me?
We could hear that, Assemblyman, when we're ready to go. Thank you. We just, there's enough of an echo here in the room that it's a little difficult to understand. So this is Director Cameron. I'll respond on the NAIC Special Committee on Race and Insurance, and want to acknowledge and thank the NCOIL for its work over the last couple of days, and we look forward to reading and understanding your work and collaborating on that. I have to tell you, a year and whatever months ago that we started this, one of the first persons I called after the NAIC officers deciding to take on this issue was to Matt Lehman, because we knew that this was a big enough issue, an important enough issue, and that we all despise inappropriate discrimination and unfair treatment of your constituents and consumers. He was one of the first persons I called. In fact, probably was the first person I called afterwards and solicited NCOIL's help. Now, as you know, the NAIC created the Special Committee, Executive Committee on Race and Insurance last summer, the first of its kind in history. It is currently co-chaired by NAIC President David Altmaier and myself as President-elect, and then with Clora Lindley Myers and of Missouri as Vice President, and Andrew Mays as Secretary-Treasurer, serving as co-vice chairs. The task force has 5 critical work streams. The first 2 work streams are on researching and analyzing the level of diversity within the insurance industry as work stream 1, and then on the state regulatory within our state departments of insurance as work stream 2. The 3rd, 4th, and 5th work streams are looking at what barriers exist in the insurance sector that politically disadvantage, whether they're people of color or historically underrepresented groups. And we're wanting to make sure that they are equally protected and treated under either our property casualty or our life and annuities or our health insurance lines. The full committee met a few weeks ago to hear comments from interested parties on our draft charges. And we just recently this week discussed those draft charges again as an NAIC. And we will be publishing those draft charges on after our July 21st meeting, in which we hope to adopt the charges for the remainder of 2021 and through the 2022 year. And those charges will be on our website, and we will make sure that NCOIL has an opportunity to see those charges and would appreciate any thoughts or comments. We know that they're not going to be perfect. They're not written like Dean Cameron would write them, or Mike Cheney or Glenn Mulready would write them, but they are a combination of voices within the NAIC. The special committee will hold a public meeting during our national summer meeting, which will take place in Columbus in August. And meanwhile, the other work streams will continue to work, meet, and gather information. I think certainly Commissioner Mulready was there at the meeting and just earlier this week. I would say that there is a variety of opinions, stronger than some others on this process. And so it's taking a little longer than we would hope. As you know, the NAIC is a thoughtful and a deliberative organization who takes its time on things, but we are committed to exploring and making sure that there is no unfair discrimination, unfair bias, proxy discrimination, or desperate impact on the products that are being offered. But we acknowledge that these are complex and difficult issues, and we need to be deliberative in order to avoid unintended consequences in the market. We have been working equally with our consumer representatives as well as the industry in order to make sure that things are treated appropriately. And we have to say we are encouraged with the open unprecedented discussions that have taken place uh, uh, on these difficult issues. And I'll stop there and let my colleagues add if they want to add anything to it.
Thank you very much, Commissioner Cameron, for that overview. Why don't we jump in at this moment? As you alluded to, Neil Breslin, New York, Matt Lehman together have helped us through 5 sessions of our special committee on race and in insurance underwriting. And that body concluded its work and wrapped it up yesterday. There's an ongoing, just a curiosity about what the long-term plans are for the NAIC group. But Representative Lehman, would you like to offer some comments about our experience and work product?
Sure. Thank you, Mr. Chairman. We did wrap up yesterday with our special committee with a resolution we passed. So we passed 3 resolutions, and we'll get to the others maybe later, but specifically the one on data, the use of certain factors in underwriting. And I would be remiss if I didn't say I would love to see that into the hands of the NAIC as to how that balances with the direction you're going. We did see a lot of, we had very good meetings. We saw a lot of data that was presented over the course of those meetings, and what really kind of rose to the top was the one issue we did put in our resolution, which is the arrest issue. Other issues I think are probably ripe for continued discussion. I do think it's a broader discussion in the use of the artificial intelligence, et cetera. So I think with our resolution having now been adopted, as issues come forward specifically, I think those will be assigned to the respective committees. But we will continue to watch and be a resource if needed with the NAIC as to help how we can in your programs and where you guys go with yours, and how that kind of mirrors ours or adapts to ours as well. So any other comments you guys might have on where you see your committee ending, or what direction you see them going to where they come to a conclusion at some point?
Thanks for those comments, and we'll look forward to reading the resolution. We're just informed of it this morning. Some you may know that at least Commissioner Mulready and I flew in at the dark of the night last night, so we were, yeah, not on purpose, but well, we actually left our NAIC meeting early. So, but we will take a look at it and pass it on to our committee. I know that we have a group that is also looking at artificial intelligence, how that's utilized. We have a couple of different working groups and task forces that's there. I will tell you that we are pushing forward, creating another letter committee that focuses on cyber and data and artificial intelligence. And that's sort of that's the first time we'll have a new letter committee in a long time. But that's was promoted at our recent meeting, and we'll be voting on that bylaw change probably in Columbus here in the near future. But we'll look forward to collaborating with you, because I think as regulators, we want to know what's in that black box that's determining the rates. That's our responsibility. And we think that the carriers should have to explain and be able to justify what the calculations are and how they arrived at their rate calculations. That's part of our responsibility. So I'll leave it there unless others.
Yeah, this is Commissioner Mulready. I just might add to that comment, because I think it's a good moment to just as just described, a new letter committee being added was at Dean Cameron's initiative, being pushed by our incoming president. So that was his push, and kudos to him while we were here, because we do have big concerns about that same thing, the use of the data, the whole black box thing, and rate review, and that process used to be a lot simpler just a few decades ago, but it's become quite complex. And so big concern. I think the data and technology committee will be really helpful to kind of dig through some of that stuff.
Thank you, Commissioner. What is the relationship with ongoing work adopting charges? And I sort of hear the feedback.
Yeah, I was trying to understand the question, but I think I've got it. I think your question was, what's the relationship or where are we at in the adopting of charges? We will be meeting, we discussed the charges at length at our recent meeting this week. We will be meeting next week on the 21st and be voting on those charges is the intention. They've been modified. We have sought public comment, received public comment, and have modified them to accommodate some of the suggestions made by industry, made by trade groups, made by consumers. And so those will be voted on next week. As I said, they're still not going to be perfect, but it's time that we move past adopting the charges and start to get into the real data collection.
Commissioner Cheney, you were going to make a comment, and then I want to follow up with something before I kick it back to you, Ken.
Well, I don't have a lot to add. I think Lynn and Dean have covered the subject very well, but the arrest issue is something that we'll have to tackle in the C committee, especially on property and casualty, and how do you address that issue? And I know every legislator is always asked about credit scoring and all the other issues. So with artificial intelligence and proxy discrimination, you've got some real issues with the databases that we have today because we're not certain what that data contains on artificial intelligence as an example. And if somebody is improperly discriminated against simply because of the AI or proxy discrimination, you don't know what proxy was used. So it presents a host of problems to us as regulators to address those issues.
Well, I think if I can, one of the key words I've been using, I think it was in our resolution yesterday, is transparency. It's one thing to know what's in the box. It's another to explain that to the end user. And we're seeing that now in our industry where someone will say, I know when we did credit scoring, you had to give me the factors that went into the adverse selection of my rate. Yet now I've got this insurance score, which I'm being adversely. I went from a T5 to a T7. I took in a percent or so of increase. What's in there? And the answer is we don't know. So I think part of this isn't so much, it is important what data is going in, but it's also how is that being to the end user and the consumer. And I think, and I know we got a lot on our agenda, I don't want to get too deep into this, but I think we all maybe saw the tweet that Lemonade put out about the collection of 1,600 data points. And you start to have to ask the question, what 1,600 things does an insurance carrier know about me to determine my rate? That's troubling, I think, just in the sense of unknown as to what is being collected. And then again, how is that being portrayed to the thing? So I think we're on a joint mission in a way, and that is we're all tasked for consumer protection, both you as a regulator and us as public policymakers. So I know we'll want to continue to work with you on that as well under those transparencies with the AI and then also with the discriminatory issues. So Ken, I don't know if you have anything else on that. If not, we'll go back to our agenda and then we'll have time maybe for some comments from others.
Yeah, I think that will be fine. Thank you very much for your coverage on those topics. The next item we want to take up is the topic of climate risk and resilience. Here in the West, we're seeing incredible heat. I guess all over the country, heat, fires, ongoing problems associated with drought. Can we get an update on the NAIC's Climate and Resiliency Task Force, what it'll be working on and its timeline?
Well, I'll try to give you an update that's fairly quick. This isn't a new topic for NAIC. It's an old topic. We've had a Climate and Resiliency Task Force under the C Committee for many, many years. It's been elevated to an executive task force, and it highlights our priority of trying to address at NAIC climate issues. And to that effect, the Climate and Resiliency Task Force includes 33 states and territories. It's led by California Commissioner, Mr. Councilman, you understand, Ricardo Lara, the commissioner in California, leads that task force along with South Carolina Director Ray Farmer, immediate past president of NAIC and also a former head of AIA. We have 5 members that serve as vice chairs under that group. I'm not going to give you all the details about the vice chairs, which I could do, but you don't want to be here for another hour and a half. So I'm going to give you the mission, and I'll hit it real high from here. So the mission of the task force is to serve as the coordinating NEIC body for discussion and engagement on climate-related risk and resiliency issues, acknowledging there are other groups in the NEIC who have or will need to be involved in any regulatory recommendations related to climate risk and resiliency. And that's pretty important for you as a member of NCOIL to understand that we do not work as one man on an island. We work as a group and try to coordinate some of our efforts. That's especially important on data collection, artificial intelligence with a new committee that Director Cameron is put together and directed to us. The pre-directed work stream is led by Wisconsin Insurance Commissioner Mark Fable. The building code and mitigation part of that includes 19 state insurance departments. If you're from a coastal state, you'll understand that you need building codes. This is not rocket science. You build a stronger house if you're on the coastline and stay out of the floodplain. It's just real simple stuff if we can do this. And the climate resiliency work stream, the second part of this is led by the Oregon Commissioner, Andrew Stolfi, and there are 6 states, I believe, in that group at the present time. The solvency work stream is led by Maryland Insurance Commissioner Kathleen Baren, and Hawaiian Insurance Commissioner leads the innovative work stream, which is charged to consider innovative insurance products. So you've got to have new products that may include non-admitted products to try to address some of the climate change issues, and that's things like earthquakes and additional wildfires. And then the final work stream is the technology work stream, and that'll have to work very closely with that new A&I if we adopt that as a new letter committee at NAIC. So we've got our work cut out for us on climate change, whether you agree with it or not. We do face climate change. We know from history that it's been around a long time. I'm not going to debate whether it's caused by man or not. You got to remember I'm from the South, so I may have a different opinion from some of you guys. But if you're in Arizona and you got 114 degrees, you may start wondering a little bit about what climate change is about today. So we've got some new committees that we have formed under the C Committee and the Catastrophic Working Group at NAIC, and one of them deals with FEMA, and I'm going to let Commissioner Mulready address that for just a second because he's been asked to be the vice chair along with Commissioner Dodrell out of West Virginia to address some of the issues so we can have a better working relationship with FEMA on some of the issues of climate change. So Glenn?
Thank you, Mike. I don't know that I have a lot to add, except I think that development is literally, I don't know, 3 or 4 weeks old of the creation of that new advisory group, FEMA Catastrophe Advisory Group. And Commissioner Dodrell from West Virginia will be chair. I'll be vice chair of that, but we are just getting that going. So there's been no action taken, but just emphasizing the importance of bettering that relationship with FEMA and how we can interact going forward.
Well, I certainly am familiar that climate change has been an issue at NAIC meetings for at least 15 years. We're seeing states like Connecticut start to pass statutes involving climate-related risk in the insurance business, impacts of coal, tar sands, Arctic oil, various types of regulatory actions. How do you see this movement affecting the accreditation process? Obviously, accreditation is looking at supporting the solvency of carriers. Do you sort of see a long-term integration of some of these climate issues in accreditation?
Well, if a company has risk out there that are on their balance sheet and we can't weigh that risk, it affects your surplus. So that's really our main job as regulators, is to be certain that companies are solvent enough to pay a claim. And the second part of that is to protect the consumer. So it's going to present a host of issues for us as to how do we determine, and that would be out of the E Committee at NAIC on solvency, how climate change will affect that balance sheet. There's so many things that we have to deal with on the balance sheet when you look at surplus, and that includes security evaluation, which we have an SAV at NAIC, and every other issue that comes up. So when we get to SAP 71. That's going to be another issue, but it's not climate related. But I just want to give that as an example of what we have to look at as a regulator when you're looking at solvency and what's there. I hope that answers your question.
Yes, the question was more about the accreditation, but I know in California in 2010, we passed some insurance legislation regarding green investments, and it was kind of structured in a way to adjust to make sure it's integrated with the solvency requirements and the investment rules of insurers to support their solvency. So
along that line, let me just say that as a commissioner and a regulator, I do worry about what constitutes accreditation at a state level, and we're all reviewed with 5 years, so you'll understand for accreditation. And the issue there should be that the body as a whole at NAIC should determine those issues and not one person or bureaucrat somewhere on the committee that's down in the trenches. I think that will give you some solace there, Assemblyman Cooley. I hope so. So we are addressing that issue. It's not at the top of the ladder right now.
Well, very good. Well, actually, I think, thank you very much, Mr. Cheney.
Ken, we do have a question here in the room, brief question here from Senator Nuccio.
Thank you. Thank you, sir, for the information that you're providing here. So NAIC is really an arbiter of a lot of data regarding information to help us make good legislative law, right? So yesterday we learned about the Storms Act that was effective 1/1/2021. And that talked a lot about flood, which again, we can link back to climate change. And there was a suggestion that as a state, we should be looking at passing legislation to utilize the money that the federal government is making available for floodplain areas. So I'm wondering if you guys have used that in the suggested information that you're providing regarding resiliency and climate change, and if we wanted to look at passing model legislation regarding that, where could we partner with you to obtain data to understand in our state how much is flood impacting our insurance rates? And if we were to pass legislation to alleviate those zones, what could we expect to see in terms of return from insurance?
So let me address that from state specific. I've been dealing with floods for 14 years as a commissioner and 15 years as a legislator. RIS 2.0, which you heard a lot about yesterday from FEMA, presents a host of problems for states, not so much for my state, but if you're in Louisiana, where you have almost 500,000 policies, or South Carolina, you're in trouble. But flood affects every state in the union. Just you turn on your TV this morning, if you looked at Fox News, you'll see that. The states are going to have to address the flood issue on a state-by-state basis. The problem has been the federal government has never, they talked a good game, but they've never really tried to fix NFIP. As a regulator, I've gone around that and I've said, okay, that's the case. Let's see if we can't get an admitted company to do flood endorsements, which we have been able to do in our state, and Florida's done a little bit of what we've done, and to bring in some of the surplus groups like Lloyd's Group and some of the others to write flood insurance. Now, the reason I'm telling you that is you've got to understand, can they write in a V zone or an A zone, or which zone are they going to write in? If you do away with the zones, it's not a big issue, because let me tell you, the technology today that exists today within the last 2 years that's come around, we can tell you specifically what the elevation is of a home, each individual home. We use LADAR today, and some of the new groups and technology that are out there can tell you whether or not a home was destroyed by storm surge, say in Rhode Island and Massachusetts, or whether it was destroyed by wind. So there are a lot of new things coming out. I would be careful about I would put a lot of flexibility in the statutory law if that's what you're trying to do, Representative. So I would just say, from a state-specific point of view, be very flexible in what you do. Do not kill things that are working, and leave the ability to protect that consumer. Consumers have got to buy into the flood program if they're going to be protected.
Yeah, I think I understand that, and I appreciate that feedback. What I'm looking for is basically a partner in being able to identify where we could use this to actually help mitigate that. Like, so trying to find a way to get the data to help support us writing some sort of legislation that's going to be able to utilize this federal money, because as you said, if all we are going to get from the federal government is the ability to have a revolving loan program that they're going to do a 90-10 match on, how do I optimize that in my flood zone?
So that's such an easy question. I'm going to let Commissioner Mulready answer it for you.
All right, so let's have Commissioner Mulready answer, then we need to move on to the next subject.
I don't know that I have an answer for you.
Did I stump you?
Well, except that I will just speak for myself or our state. We are ready and willing to help produce data and find data and get data to do the best things forward for your state or for our individual states, and how you can, utilize that money the best, because it is about resiliency and mitigation efforts. And so there is data out there. NFIP is not necessarily always the best and quickest at getting data from them. And unfortunately, in most states, that is the only source for that flood data is coming from them.
So let me.
You just said my magic words there. You're ready and willing and able to help.
No, you need to understand that FEMA agreed to share their data with us about 6 months ago. And now, the reason I did that with tongue in cheek about Glenn, but he is now the new vice chair. He's going to have to deal with this instead of me. And it's going to be it's a huge problem, because the data is so massive. Somebody's got to go through it. So do you use Tableau, or do you use SAP to take the data and break it down into granular data that you can actually use? The problem's going to be that you're going to get a lot of promises out of FEMA and very little deliverance.
If I could jump in,
it's just a fact.
Yeah.
We need. I'm sorry. We need to move on. We're running out of time. We still got a lot of issues to go, and you guys can touch base. Don't stick around. Commissioners aren't going to run out like they came in.
On issues like this, I want to suggest my colleague from Connecticut sitting down with your insurance commissioner and having a direct conversation about data is a good path. They can help you figure out how to access what the NAIC may have, and they have the specialty staff member. So I would say a partnership starting in your insurance commissioner's office is a good way to go. Turning now to item 3 on the agenda, review of the International Monetary Fund, if we can. In 2020, they did their financial sector assessment program. This was the third in a series looking at the entire financial sector, which includes banking, but includes insurers. And one of their recommendations, they said the targeted review of state-based insurance regulation and supervision found that supervisory independence remains to be addressed. So they treated the independence of our state regulatory system as, in some respects, in their view, something that needs to be addressed. They talked about its supervisory independence, perceived or actual, can be undermined by the appointment of insurance commissioners and their senior staff by state governors, or the direct election of the commissioners and others. And of course, that's primarily how it happens. You're either appointed or elected. So they're finding deficiencies on both those fronts. And also they expressed control about governors and state governments' control of budgets and constraints on staff remuneration. Interested in how the NAIC is viewing this sort of FSAP process, these sorts of questions. What was your reaction to this?
Well, Assemblyman, this is Director Cameron. There was the private reaction, and then there was the more public reserved reaction. I'll just say that, this is a 5-year process. It's long been felt, particularly by the international community, that they don't care for the state-based regulatory system. And of course, we strongly support the state-based regulatory system. And we know that there are even those, particularly at the federal level, that they would prefer a more centralized federal government system of regulation. They don't necessarily want to deal with the states. But we are the largest market of insurance worldwide. We really control and should control. And so while we appreciate their comments, we feel like that assessment went beyond the bounds of its authority and beyond the bounds of where they should have been. There is no evidence whatsoever, in fact, evidence to the contrary, but there's no evidence whatsoever that the way we appoint, elect, unappoint commissioners has any impact on the solvency of the insurance industry and in America. And so we respectfully disagree with their assessments. You ticked off a few of them. There was a suggestion that you as legislators should change the way that those of us that are appointed so that our term is a set term and coincides with the governor's term. Well, that's again, really beyond their authority. There are, there's nothing, in my opinion, whatsoever that indicates that our markets are less solvent because of our current appointment and election process. So in the interest of time, I'll stop there. There are a number of suggestions that if we need to get our blood pressure up, we can read them, but I'll leave it there.
Well, when I see these sorts of comments, Commissioner Cameron, I actually was advising the Assembly in the 80s when accreditation on insurance, running their committee on insurance, when NAIC adopted accreditation. And the earliest accreditation statute passed in California went through my committee. So I certainly recognize that the NAIC has its long tradition of accreditation related to required laws, financial standards, organizational. I think you're 30 years in your annual insurance department resources report, kind of profiling what is the staff support for an insurance department, setting a sort of implicit standard for what is adequate staffing to meet the regulatory challenges, and your licensing laws. So I partly view this as they don't understand the character of the work and law and thought which undergirds our state regulatory system. And while I always am worried about delegation, I think on this issue, the accreditation standards are very important and are something to be educated them on. But I can understand your private consternation and more temperate public remarks. It is the age in which we live. Any other comments on that end? Tom?
No,
Matt?
thank you. Thank you for those comments on accreditation. We certainly take that seriously and work very collaboratively together to make sure that those are appropriate standards to protect consumers and to protect the solvency of the industry.
Right. I do think that the climate change efforts need to be kept in the solvency conversation as we start looking at rules of investment rules and how that relates to resiliency and sustainability. We need to keep a focus on its impact on solvency. So I see these as two very interconnected conversations. Moving on to item number 4, we continue to have interest in SSAP number 71. And as you know, sort of the bottom line for us, we feel we are in a time of economic turmoil. For those companies affected, NCOIL has favored a 5-year implementation of this. Is there any update on this topic that you wish to make?
Yes, Representative Mulready, Commissioner Mulready going to take this one. Assemblyman, sorry.
Digress.
A little slip there. To give you a quick update for those that maybe have not been tuned into the SAP 71 issue, basically is tied to insurance companies utilizing third-party arrangements to sort of finance commissions, upfront commissions, and the accounting of that. So we had our accounting practices task force reviewing that, And they had determined that that was a non-substantive issue versus a substantive issue. That's not inconsequential, because the way that process works is if that task force calls it a non-substantive issue, they're just saying they're clarifying something. So that immediately goes into effect with their vote and approval on there. The officers, I think in a very wise move, chose to, could still call it non-substantive, but we're treating it as though it's substantive. So it went through multiple step process. So it was voted on in March through the task force, moved on up to the E committee, and that was voted on April 13th. And we will next address the issue in our August meeting here coming up in a few weeks in Columbus. I will let you know from an update standpoint, two of the things that are impacting it most substantively, sorry for reuse of that word, but are number one, the implementation date. The original implementation date that was set in motion was December 31st of this year. Well, there's a number of regulators who believe that that is not a fair timeline at all, given that we're not going to vote on it until August. And you're going to ask those companies, again, it's only a handful of companies. This isn't a widespread practice we've discovered, but the thing that's still up in the air is the actual implementation date. So there's a lot of move afoot to push that ahead a year or two, but to allow that phase in. Another move that's in the works is a change in our bylaws. Commissioner Donlin from Louisiana has put forth a change in our bylaws that really would require any of those E-committee decisions and those task forces to trickle up as this one has, but that would change our bylaws going forward. But there's also discussion about changing the rules in that committee. So that decision will be made and voted on in our August meeting as well, whether we change that within the rules of the committee or we make an actual change in the bylaws. So I think one other thing I might just throw in there is that some suggestions by others are that it should just be handled with a permitted practice. Some of the pushback by some of the regulators are that, permitted practices aren't, in some circles are sort of frowned upon or getting dinged upon on that for in the different accreditation process or whatever. So not thrilled about that, some regulators, but those are the key issues at this point, and kind of it's the status of the SAP 71 issue.
Very good, Commissioner. So obviously in prior conversations, NCOIL had recommended a 5-year phase in. I'm hearing you're saying that there is conversation about a delayed effective date from within the NAIC as they sort of debate the timing of the decision. So do you anticipate that it will probably not be made effective on December 31st of this year?
Yes, I don't. My opinion would be that I think there would be a push to delay that implementation. Now, the question is how far. I also don't believe, to be transparent enough, that it's going to be out 5 years. Most of these arrangements don't even carry out 5 years on some of those. So I think somewhere there may be a delay in that implementation. I don't believe it'll be 5 years. I also don't think that it's going to be December 31st at the end of this year either.
Well, that's a very good update. I believe I have a question for Mr. Considine. Tom?
So yes, Mr. Chairman. So I don't want to ask an impolitic question, unless maybe I do. So we almost have 3 commissioners here who it's preaching to the choir on this issue, Mr. Chairman. So I'm just wondering, Commissioner Moretti, if sitting on either side of you, or maybe instead of you, if we had the Commissioner of Virginia and the Commissioner of Maine, would your confidence remain as high that the effective date would be put off this year?
They would clearly have a different perspective.
I will add in, Mr. Considine, that this was discussed also at our other recent meeting, and I think I think most would like to see a resolution. There are very strong opinions on both sides of it, but I think most would like a reasonable resolution. I think Commissioner Mulready was trying to allude that it won't likely come into effect December 31st of this year, but I don't know whether we'll get a 5-year phase in. It may be a a 2-year or a 1-year phase in, but something like that.
I might add too, I do not mean to disparage my colleagues in any way with that, except that what you'll find is if you have commissioners that have come from the financial world or the accounting world within an agency, they tend to have a very rigid perspective versus, I think, more of a global market perspective maybe that you would see within us here.
Okay. Is that responsive, Mr. Considine? Very good. In view of the time, if we can move on to item number 5, the FIO, Federal Insurance Office, request for information on the personal auto insurance market. Under their federal statute, this is certainly the sort of thing that they seem authorized to do, to monitor trends and to engage in inquiries on how the market is working. This came out in just the last 2 months, late May, I believe. And one could hardly ask questions about, seek information on these markets without being in the NAIC's bailiwick. So is this something that you have responded to or plan to provide some responsive information to the FIO on?
Councilman Cooley, NAIC will respond. It's going to take us some time for the benefit of those in the room and those listening on Zoom. We've been dealing with FIO on automobile insurance for well over a decade. And so to define it very succinctly, there is a move by FIO to have one universal type automobile policy run by the federal government, claiming it's run by the states. It's become an issue, and the bottom line is we're state-based regulators, and that's where it needs to be. We do not need the federal government telling us what our automobile premium is going to be for everybody in the United States. It would be a nightmare. So we will address it. I could talk for a long time. I don't see any need to spend 30 minutes on the subject unless you want me to.
No, that's good. That's good. Any comments from my colleagues there? Then I'd like to jump to the long-term care insurance multi-state rate review framework. Obviously, we heard yesterday in the guarantee fund conversation that they look at long-term care as an issue of long-term interest and concern to the guarantee funds generally. It is outstanding the way in which NAIC has responded to the gravity of the long-term care environment. Solvency, how it affects customers. Is there an update on the status of your long-term care insurance task force that can be provided to state lawmakers?
Well, thank you, Assemblyman. This is Director Cameron again. I'll try and answer this one, and I'll try and be succinct. We see this as an existential threat to our state-based regulatory system because the number of companies have dramatically diminished. I mean, it wasn't too long ago we had over 100 insurers writing standalone long-term care products, and now we have less than 20. In fact, probably even less than 15. And we have roughly about 7 million policies in force nationwide. And the solvency of those companies are a continued threat. Seems every year we've got a new company that is potentially in a solvency issue. And so it remains a top priority. One of the challenges or issues that we have faced, of course, there are many challenges to this whole market, to the fact that it was not appropriately underwritten, or the actuaries did not adequately account for the increased costs, the morbidity, the mortality, the length of time people would keep these policies, the declining interest rate, all of those kinds of issues. But on top of that, as state regulators, every state has addressed these issues differently. And I know it will be shocking to you, but each carrier may be presenting their need differently to each state. And so we've had a number of issues. One of the solutions that the task force has been working on is a multi-state review framework. The multi-state review framework would allow multiple states at the same time to gather information in a collective manner, and then that data would be shared with each state. It does not, however, take away any authority or responsibility from the state commissioner to review or do its own analysis. It's just merely an additional data point, a reference point by which we can determine using the same methodologies and the same information as to whether a rate increase is needed. And by the way, we know that the lack of rate increases is leading to the insolvency of some of these plans and then some of the companies. And so it's a balancing act. We're working really hard to protect consumers, to make sure that they're not priced out of the marketplace, but also that there is a product in the marketplace that they can be able to purchase at an affordable rate. We have continue to make inroads with Congress, proposing different ideas as to how to improve the marketplace. The most recent one was support of legislation that would allow people to take money out of their IRA or their 401k to help pay for premiums for a long-term care product. Those have all been endorsed by the NAIC and are being supportive. And we continue to look for other areas to provide solvency in this very touchy area.
Yeah, are you looking at how to present, compare, analyze, support consumers if they're presented with a modified benefit package, a reduced benefit package? Is that something that NAIC is including
Absolutely.
in the conversation? Yeah.
Yeah, absolutely. We do have a subcommittee of our task force that is focused strictly on that. And as you know, there are a couple of other legal issues where the NAIC or NAIC members are involved in trying to protect consumers and make sure that consumers have A, adequate information, and B, have appropriate choices moving forward.
Very good. Yeah, it is a complex issue here in California. Just this week, the California Public Employee Retirement System settled a lawsuit with about 79,000 retirees who had bought a policy 15 years ago with a guaranteed benefit, no increases in rates. And that's a $2.7 billion settlement potentially around their long-term care product. So it's a very complex issue. Senator Hackett, you have a question?
Yeah, I do. And I appreciate everything you said, Commissioner, and totally agree about that. One of the questions I found out in Ohio is Ohio during the pandemic they shut down all increases, which I think was a major mistake because all the money's coming down from the feds. So when you kick the can down the road, when the increases, and we have a new commissioner, she's dealing with it, but it's a tough issue. Was that primarily a state like Ohio, or did a lot of the states do the same thing? I mean, did you guys recommend to hold off on any type of increases during the pandemic?
There was no recommendation from the NAIC. In fact, probably to the contrary. None of us like rate increases, but at the same time, when the solvency of the company is showing that in order for them to stay alive, there's got to be some sort of an adjustment. We want to make sure that it's a reasonable adjustment, and we also want to make sure that one state isn't subsidizing another state, and so that's part of the effort on our MSA. Once it gets up and running, we've run two or three test cases through the system, and trying to show folks how it will work. Hopefully that'll be there, and then it'll be one more data point for which a commissioner will be able to address.
Okay, we'll be very brief on a final comment here from Commissioner Mulready. Then I'm sorry, call you Commissioner Mulready.
I've been called worse before.
But I know you're so much older than he is. We really have a hard stop with the governor here, so we'll take your final comment, Commissioner Cheney, and then we'll move on.
The real issue for the states is most of us do not control or regulate the rates. We do it by what we call desk orders. The issue before NAIC now is that the Senior Health Insurance Program in Pennsylvania is asking, along with Virginia's commissioners, Scott White, to let the court set the rates for all the various states since SHIP is in rehabilitation, and that's a bone of contention with states that say we should set our own rates state specific. So that's a real issue. We'll work through this. Several states, including my state, have joined in either with an amicus brief or a suit to try to rectify that. So the bankruptcy court cannot set the rates for us.
And I might just add, those are being led, those efforts, pushback against that for consumer protection is Louisiana in one court, and then Massachusetts here and Maine are leading the effort on the other one.
Very good.
All
Well,
right.
thank you all very much. Commissioner Cameron, Mulready, and Cheney, thank you for your participation here. I know we have the governor ready for the luncheon. So
I also know, if I can, Mr. Chairman, there were a couple people that maybe had a question yet. I know the gentleman will be willing to stick around for a few minutes and try to answer those specifically. But if not, I'll turn it over to you for an adjournment, Mr. Chairman.
very good. Yes, this meeting is adjourned. Thank you again very much to our insurance commissioner guests. We are adjourned.
Good afternoon, everybody. And I thank you very much for joining this session of the NCOIL summer meeting. This session is focused on oversight, the delicate balance of legislative oversight. I'm Assemblyman Ken Cooley from California and NCOIL Vice President, and I am moderating this session. We have an excellent array of speakers today to kind of focus on this important topic. But I want to go back to something Governor Baker said during the luncheon. He talked about, he actually expressed, you learn more when you talk to people with a different view than if you just talk to those on your side of the issue. I think that's a very profound insight. It's something that as lawmakers, we have to rely on, that we engage people, all the more so because we actually have constitutional standing. We sit in the respective people's houses, the body that represents most directly our state's citizenry. And it's frequently our job to kind of act on their behalf vis-a-vis.
Mr. Chairman, can I interrupt you for a second? Folks,
yes.
We're going to ask you to please sit down and settle down. If the conversation you're having is imperative, we're going to ask you to take it out into the hall. Thanks. The conversation you're having, two women, I don't know who you are, below the door. If you could either sit down or take that out into the hall, and the folks behind them. Hello? Thanks. Back to you, Mr. Chairman.
Thank you, Mr. Considine. So yeah, the power of oversight is actually a vital part of our office as we undertake to live out the powers of our office on behalf of our constituents. It is a part of that deliberation that the governor was alluding to, talking to people different than you, learning what's going on. But then I think as lawmakers, we all know we keep an open mind until we form a clear opinion and then we act upon it. Definitely the purpose of an open mind in a public official is to close it on something solid, to decide, so what does that mean that I've just learned and where do I go? This is something that is vital to the role of oversight. We first took up the issue of oversight in the spring meeting during the Multi-Lines Issues Committee. And there we were joined by Ben Ike of the Levin Center at Wayne State Law. Levin Center is named after Carl Levin, who for more than 3 decades served in the U.S. Senate and was very, very active in oversight, both budgetary and programmatically in the U.S. Senate. And the Levin Center actually honors that tradition and is working to develop oversight as a toolkit in American democracy for legislative bodies. In California, I've worked on developing an oversight guide, which we use in the state of California. And for those Western state lawmakers that are here today, the Council of State Governments West likewise has an oversight handbook that has been prepared for CSG West participant states. And on the NCOIL website in the materials area. If you go and look for materials and presentations, you'd find links to both of those items. So at this time, this is a very important session, and it's really about how do we exercise our office on behalf of the public with respect to insurance, but actually there's implications that are broader than insurance here. We have a very bipartisan panel, very focused on the constitutional dignity and co-equal status of the legislative branch of government. And I similarly think, understanding the importance of these types of oversight conversations, those of you that are in the industry in the room, you will learn things about maybe how to frame issues, how to bring attention to something. So with that, I want to turn to Ben Ike. He is a manager of state training and communications at the Levin Center at Wayne State Law. He will be joined by John Sylvia, Director of Performance Evaluation and Research Division in West Virginia's Legislative Auditor's Office, and then Michigan State Senator Ed McBroom, who chairs the Michigan Senate, Senator, Oversight Committee. And so we just want to pass the baton now to Ben Ike. I'll let you take it away, and we're off. Thank you.
Thank you so much, Assemblymember Cooley, and for your leadership on this critical topic. Good afternoon, everybody. As Assemblymember Cooley said, my name is Ben Ike. My mom was a kindergarten teacher in Flint Community Schools for 32 and a half years. So to pronounce that last name, you point to your I and you turn a key. So Ike. And that is my contact information, which I'm sure will also be made available after our presentation. Delighted to be here.
Very good.
So I want to start off by saying a couple of things about the Levin Center, located at Wayne State University's Law School in Detroit, Michigan. We are a center dedicated to the expansion of legislative oversight. We have been around since 2015, been very focused in DC. We do congressional boot camps, and we have also made the decision to go further and enhance oversight within state legislatures. And that is the path that we have taken, and it's been incredibly fulfilling. It's been wonderful to be able to get to know so many great people across the country that are using their oversight capacities to be able to gather facts, get the information needed to be as thoughtful of our approach in lawmaking as we can be. We have several different events and outreach that happen all over the country. We do panels, we do a variety of different discussions, and we also conduct research on legislative oversight. The first one being our 50-state study. So in 2019, we published a report looking at just the state of state oversight. We looked across the entire country, and we, using these 6 dimensions of oversight, your analytic bureaucracies, your appropriations process, committees, administrative rule review, advise and consent, and monitoring contracts, we determined the current use and capacity for state legislative oversight in every state legislature across the country. One thing we noticed across the board was that monitoring contracts was a short-suited area, and as I'm sure many of us are familiar, that became quite a liability in light of the pandemic in this previous year. So as a result, we also have published research back in April looking at several states that have been seeking to improve their contract oversight in a wide variety of ways, which I'll also be able to discuss further. Also, even though it was only a few years ago, we've already seen improvements in places all across the country. And for example, in Alabama's legislature, we had somebody that contacted us that said, hi, we had a score on analytic bureaucracies that was probably true in 2019, but we've changed, we've made improvements. And we had a wonderful discussion with them, and yeah, certainly convinced us. So we are in the process of doing updates to the report as well. We want to see this as a living body document that is as up to date as possible. So when looking at contract oversight, a couple of things that we did in this previous year. Back in the fall, we just published a case study looking at particular contracts that were among the more problematic ones in the country in light of the pandemic. We found contracts that were for testing materials that had issues. We found a lot of consulting contracts for unemployment systems that did not perform adequately, and we just used that as kind of the start to be able to suggest different ways in which legislatures can use oversight to be able to try to gather facts on what exactly happened and what can be done in the future to try to improve the processes as we move forward. That also came up in April with our state government contract report. We looked at several states across the country, just states that are looking to be able to try to enhance this particular area of oversight. It was a very positive report. I really enjoyed being a part of that. And up next, our focus for the upcoming year is going to be appropriations oversight. That's primarily my background. Prior to my work here in the Levin Center, for 3 out of my 4 years working in the Michigan House of Representatives, my boss was the chair of the Corrections Appropriations Subcommittee, and had an opportunity to conduct some wonderful oversight, gathering facts on our corrections system in the state of Michigan and being able to find ways to be able to make the system run a little better. I was very proud of that work, and really is what inspired me to believe in oversight as much as I do. Just to give a little bit of a flavor of just some of the different events and outreach that we do at the Levin Center, I have a State of Oversight listserv that every other week or so, we collect stories about oversight on a state level from legislatures all over the country, and we put that together into a nice, really readable email that will be sent on the listserv. Feel free to send me a message if you wish to subscribe. We have an Oversight Matters podcast, which is hosted by me. I've been told I have a voice for radio, and now I have a chance to actually try it out. And we've had several really great interviews, and more coming soon on that as well. And then just to give a little bit of a few of the panels that we've had recently, we had a very, very well received panel with several different elected officials from across the country talking about the challenges of trying to conduct oversight in light of the pandemic. And we had a bipartisan panel. We had just incredibly thoughtful members from all across the country, from California, Idaho, and Nebraska, who were all there, and we were all able to discuss different ways, different approaches to be able to conduct oversight. It was a wonderful experience. We did a panel about corrections and reentry. Again, leaning a little bit into my background with that type of work, thought a lot about the process of reentry for parolees and for those that are trying to reenter society in different ways in which oversight can have that sort of a role to be able to monitor, to get the right information that lawmakers need to be able to create proper priorities to be able to get people on the right track. U.S. disaster policy, we have a Levin Center scholar that every year is selected who writes a paper about the oversight topic of their choice. The scholar this year was Professor Kristen Taylor, and she was able to write a report about oversight of U.S. disaster policy from 2016 to 2020. And there was a lot of discussion, particularly on the federalism issues, looking at interactions with FEMA and the federal government and the state legislatures when disasters strike. And there was always this balance between prioritizing mitigation to try to keep disasters from happening in the first place, but then the triage that must occur when they do occur. That was very positive. I mean, not that disasters are positive, the event was positive. And then we're always open to different suggestions, different priorities. We want to serve as a resource for state legislators across the country that are seeking to improve their oversight. So if you have a topic, if you have something that you've really been wanting to work on and you want to be able to kind of, get a national perspective on it, we're here to help with that in any way we can.
Very good.
Oh, and we have a new website coming as well, which we're excited about. Oh. I wanted to also give just a couple of specific things that we've been doing with state legislatures across the country. In Nebraska, there's a study resolution that has been introduced by a state senator there. And coming up this fall, I'll actually be visiting Lincoln to testify in support of the legislation, or the resolution, to study oversight. The Nebraska unicameral wishes to conduct a study to look at their current oversight capacities and find different ways to be able to improve. So looking forward to being a part of that and being able to be of assistance with that effort. In California, a few months ago, we had a very well-attended 1-hour presentation on oversight in California. Assemblymember Cooley was wonderful in his leadership on this. We were able to hear from various analytical bureaucracies in California. We were able to discuss as well. There was broad participation, big bipartisan event. Assembly members and senators from all across the state of California were there. It was very well attended and very well received.
On that, I will say, Ben and group, California, we have gone to a longer system of term limits effective in 2012. In my own house, it had been 6 years. It's now 12. But so you had a whole crowd of legislators who were very young in their careers. So they arrive at the Capitol, they understand right away, well, there's this activity of passing laws, but the whole concept of tracking what was already on the books and how it is being implemented is, for many of them, sort of an undiscovered realm. And so there's an interest in oversight as members realize the size of their office, both for new laws, but tracking what's already on the books and how it's being implemented. Proceed, Ben.
Thank you. And then we are going to be going to several state legislatures across the country to have committee hearings discussing our contract oversight, discussing appropriations oversight, really any topic that relates to this. We're going to be going to North Carolina, Nebraska, Michigan is tentatively scheduled. We're still looking for the right day and right time for that as well. But we're more than happy to be able to go and show this being a priority in any state legislature across the country. And then also we conduct workshops. We do workshops anywhere from a 1 hour long to a full 2-day comprehensive oversight workshop. We did a full 2-day workshop in Pennsylvania's legislature when they were looking to expand their oversight capacities. It was very well received. We're very proud of that offering, and that's something that I'm happy to talk about further if anyone interested. I also love that graphic. I think it's just so neat. So when the Levin Center was invited to come here this afternoon to be part of the NCOIL summer meeting, the team all kind of got together and brainstormed a little bit because, we're the oversight experts, and we thought a lot about just specific opportunities within insurance that could be related to oversight. And this is just a quick list that we came up with of some of the different opportunities that we could certainly see for those that are looking to enhance their oversight within the context of insurance. And those sort of things are all available there. I want to say thank you to everybody for this wonderful opportunity this afternoon. I've made a ton of friends already just from being able to be here and be a part of this and be able to prioritize the Levin Center and our oversight and the work that we do. And I just wanted to express my gratitude for that. And I'm happy to answer any questions. I think are we gonna hold on questions until we're all through? We are. Okay. So I guess at this point,
Yes, Ben.
Okay. Thank you. And thanks again, everybody. And at this point, I'll pass it over to John Sylvia from West Virginia. John.
Thank you for joining us, Mr. Sylvia. We're delighted to have you.
Well, thank you, sir, and thank you, Ben. I do want to express my appreciation to be invited to this conference to discuss something that I've been involved with for now going on 35 years, working for the state of Indiana and now with the state of West Virginia. I am originally from Boston, and so coming back here was a pleasant visit. And some of the people who heard that I was going to be making a presentation in Boston kind of said, that's pretty tough to have to do. And I said, yeah, it's a tough job, but someone's got to do it. Yes. But I've been able to enjoy the sights and see how the city has changed. But I thought what I would do is just present, I guess what you'd say is the landscape of program evaluation. Many of you as legislators, I'm sure, are familiar with the NCSL, the National Conference of State Legislatures. And within that organization, they have a subcomponent called the National Legislative Program Evaluation Society. And it represents states that have program evaluations. And periodically, they do a survey of those states to ask a variety of questions as it relates to their program evaluations within their state. And so I thought I would share some of the survey results of the 2019 survey. So let me begin. This is a list of the states that responded to the May 2019 survey. There were 39 states and the District of Columbia that responded to the survey. Now, this does not mean that these are the only entities out there that have program evaluations. It's simply those that responded to the survey. I highlighted the state of North Carolina there, and I do so because at the time they had a program evaluation in place, but as of February of this year, a significant portion of their program evaluation has been eliminated, and that was as of February of this year. And that was rather disheartening for many of us in the society to hear, but we know that these things do happen. This is a question that was asked those of the survey: which best describes the organizational placement of your office or your unit? You can see that of the 40 that responded, the 16 indicated they're within a legislative auditor's office. My division is within the legislative auditor's office. We are required to be nonpartisan in everything that we do. It's a major requirement. And then you see that there are 15 that identified themselves as an independent legislative audit unit or office. And then there are those that 4 identified as being a part of a legislative oversight committee that spends most of its time doing performance audits and evaluations, but also do other legislative work. And then one state indicated that they conducted performance audits, but spend more than half of their time on other functions such as fiscal notes and bill drafting and so forth. Another question was asked: is your office or unit authority codified in statute? You can see the large majority indicated yes. My division is in code, and we're identified as having the responsibility to do what we do, and to some degree is described what our responsibilities are. There were 4 others. No one said no, but there were 4 others that identified as being in statute and Constitution, and also established solely in the Constitution. This question asked, does your state have any other offices that conduct audits or evaluations other than internal audits within specific agencies? And you can see 24 said yes, and 16 said no. That's kind of a concern if you only have one office that is doing performance auditing or any type of audit or evaluation of programs. In my state, we have my division. There's another division that does program evaluations. We have a constitutional office known as the Auditor of State that does evaluations on a variety of topics, one of which their major component is looking at purchase cards. As many of you know, the states have gone more towards the use of P cards. We call them P cards, but they're purchase cards. And so those are audited by the state auditor. And then we have another entity called the Commission on Special Investigations, and they primarily look at fraud instances. Then the question was asked: how many full-time equivalent positions does your office or unit currently have? This is as of May of 19. You can see that there's a wide variety here. You have 7 states that identified having a staff of no more than 10. We fall in the category of the next one, 11 to 20. I have 19 authorized positions, but right now we have 15 that are filled. You can see some states have big offices. There are 6 that identified having 50 or more staff for their program evaluations. And then the question was asked: how many audit reports do you issue? And this was as of 2018, the year before the survey. You can see that there are some that between 0 and 5. Then there are some, 6 to 10 reports a year. We fall in the category of the third one. We do probably, and on average, maybe about 15 reports a year. And it's a variety of issues that we report on. And then you have some that are out there that issue 20 to 30 reports a year. Within the past 5 years, the question was asked, has there been a viable threat to eliminate, substantially downsize, or merge your office or unit with another? And you can see that 30 said no. There were only 34 that responded, but 4 said yes. And as you know, as I indicated already that North Carolina experienced actually the discontinuing of a major portion of their program evaluation. And then another question was, does your office or unit undergo a peer review? Now this is important. You can see that 15 said no, 25 said yes. A peer review, we go through a peer review under the general general accepted accounting standards under the Yellow Book, and it requires us to go through a peer review at least once every 3 years. And this is important because as a entity that is evaluating other state agencies, there are certain ways that you want to hold yourself and conduct yourself in these audits. And so one of the things that they really look at is, are you independent? Are you objective? Obviously, we don't want to tell the legislature what it wants to hear. We want to tell the legislature what it needs to hear. And so independence is something that our standards require us, and they evaluate our independence. They also evaluate our communication with the agencies to make sure that we are being fair to them, giving them opportunity to know what we're going to look at and how we're going to do this and that sort of thing. So that's very important. And I think it's also important for me, and this is why, because I was asked on more than one occasion, okay, who audits you? So we're looking at you, but then they ask us, well, who looks at you? And so this is when we have our peer review, it allows other states, our last peer review actually was a few months ago, and we had the state of Colorado, Nebraska, and Atlanta, Georgia, the state of Georgia. Those 3 states came and evaluated our processes. And they gave us an objective view of how well we're doing and that sort of thing. And it's important for me because I know that if I'm going to be audited, it does help me to keep myself on track to make sure that we are doing as we should do. So it's always important to know that I do have someone that's going to be looking over my shoulder in the next couple of years, 2 or 3 years. So this is an important part of the process. And I believe that's the last.
This is Ken Cooley. May I ask you a question related to this? Both for yourself and when you look at other states, what's the general rule when the legislature wants to ask information from the executive branch and is seeking detailed responses? Is that always easy, in your opinion? Do you sometimes have to fight to get the information? Obviously, the quality of the information you get from the executive branch agency affects the caliber of your analysis. We actually don't always have statutory authority to compel state agencies to give information, so it can be a little bit of a tug of war. Do you see that as an issue of the ability just to ask the other branch of government for information and get them to reply?
Well, I can only speak primarily to the state of West Virginia, and I can tell you that in our code, it's Chapter 4, Article 2, Section 5, it states clearly that the legislative auditor has the authority to examine every state agency. And so that's understood when when we, and this is the second, probably more important component, is that many of the audits that we do are statutorily required. We have another in Chapter 4, Article 10, Sections 8 and 10, by law require us to look at these agencies. It indicates, for example, all the regulatory boards. We have about 33 regulatory boards that oversee all the professions. And there's a schedule, and we are to look at least 3 of those and look at all of them within a 12-year period, but we normally do about 3 a year. And it indicates what agencies are going to be looked at, what boards. Right now, we're looking at the Board of Medicine, the Board of Pharmacy, and the Board of Dentists. And then we have 10 departments in West Virginia. And the law requires that each of those departments are to be examined at least once every 7 years. It's on the books. So they know when we're coming, they know the year we're coming. And when we knock on their door, they know that they have to give full cooperation because the legislative auditor has that authority, and the legislature has mandated that they be examined. So we have never really, in West Virginia, we have never encountered any resistance from the executive branch. Now, that's not to say that they do kind of have concerns of maybe what our motives are, I've been accused probably on more than one occasion that we're looking at a specific area of your agency for political reasons, and that does come up. But
I think this is a good response. I didn't want to get you off your topic. I think for every legislator, the most notable thing here is Mr. Sylvia, when I asked the question, could immediately cite to the statutory provision that supports them asking questions. And so a good takeaway for every lawmaker here is to make sure you know what is the authority in your state for legislative inquiry of executive branch proceedings and evaluate it. And if you want to try to strengthen it, go after it. But please continue with your presentation, Mr. Sylvia. We are still going to try to end at 2:45, notwithstanding the adjustment transitioning from lunch. So please continue.
yes. Yeah, so we send a letter to the agency. In the letter, the first letter, what we call our entrance letter, requesting to have a meeting, an entrance conference with them. And that letter specifies the law that requires that we examine your department or your regulatory board. And we follow the yellow book, which is the GAO standards, the Government Accountability Office. And it indicates that we are to try the best that we can to tell the agencies what we're going to look at, how we're going to look at those things, and give them opportunities to respond and let them know when we intend to report, issue our report and that sort of thing, give them the timeline. Just to be fair, because we know, and I've learned from personal experience, that, for many of the offices that we've looked at, some of the people working there have been there for 20 years, 25 more years, and this has been a career for them. And the work that they do means a lot to them, so they want to be treated fairly, and they want their program to be evaluated objectively. And so we strive to do that. And I think that pretty much is a good way to end my presentation on this. I'm open to any questions.
You're muted.
Mr. Chairman, you're muted.
Yes, I think we're good. We're going to move on to Senator McBroom. Mr. Ike, would you like to introduce?
Sorry about that, Assemblymember Cooley. It was a little distorted, so I'm happy to do a brief introduction of Senator Ed McBroom. I've known the senator for a good number of years. I interacted with him quite a bit in the Michigan House, and I was very fortunate to be able to do so. The senator is the chair of the Michigan Senate Oversight Committee and is here today as an oversight expert to be able to discuss and share with all of you his experiences as an oversight expert and his work. So I would love to introduce him now. Thanks again for being here, Senator. I really appreciate it.
Thank you very much.
Well, thank you, Ben. Thank you, Mr. Chairman. It's a pleasure to be with all of you. I'm sorry I couldn't be there in person. The schedules didn't work out quite right, and I have a dairy farm that I operate as well, and we're in the middle of haying season, and things didn't go well on Wednesdays, so it just changed my whole schedule around a bit. But it's my pleasure to get a chance to speak with those of you who are interested about oversight. I can tell you that in Michigan, as was mentioned, Mr. Chairman, you mentioned term limits. Michigan adopted very short term limits, such as you had in the early 90s when many states were doing so. And Michigan, I believe, is the only state that remains having the exceptionally short term limits that we do. And as I became aware of what was going on, coming in with a big class of freshman members, such as you mentioned, Mr. Chairman, it became very apparent to me right away that the legislature had lost its mojo, if you will, when it comes to oversight. And it's not a good committee to raise money on. And when you have short-term limits and you're replacing so many members so often, leadership sets up members to be into committees where they're going to have some success in being able to fundraise. Oversight's not that place. And so oversight had lost a lot of that clout and credibility that you still see it have in Washington. It had certainly lost that here in Michigan. As I gathered interest in the issue, actually went back to chairpersons who had served prior to term limits in Michigan to get a better understanding of how it was done, to get a better understanding of what could be done. And for me personally, as I sought office and came to Lansing, I had a huge bee in my bonnet that I was going to go after departments that to get after all of the aggravating things that citizens complain about every day. Why are they not letting me put a shed up here? I mean, what is this in our wetlands regulations that won't let me have a 2-bay snowmobile garage instead of just a 1-bay snowmobile garage? And it just drives people crazy. And so I wanted to be on committees that were going to deal with those natural resources and farming issues. But I quickly discovered that my legislative colleagues, as much as they might agree with me, were also on those committees for their own personal, important policy development reasons. And so to ask them to take an antagonistic position against various departments that they had hoped to work with to get policy through and eventually get a governor's signature on became very difficult. I could get all the sympathy nods I could desire, but I couldn't get any help to actually take on the juggernaut of bureaucracy. And that's when I realized that the place I needed to be was on the Oversight Committee. And so in 2014, I asked the incoming chairman of Speaker of the House to allow me to chair the Oversight Committee. As I mentioned, I met with previous chairs from the 90s and began to develop a strategy. And so, I think that Michigan, clearly we had a deficit with oversight that could be traced to our term limits, could be traced somewhat to lobbying and campaign finance issues, but it also was very traceable to the ideas that we could fix problems by just having private meetings. And so a lot of members would call up the department head, would call up a division director and say, come in and meet with me, there's this problem going on. So one of my constituents is unhappy with this. Or even if we got an audit from the Auditor General, there'd be a private meeting. And sometimes that would actually fix problems and everybody'd walk out happy, your constituent would get what they needed, but it didn't actually long-term change the practices of the bureaucracy. It didn't change the practices of the departments. And it became my practice to have private meetings to prepare departments and directors, et cetera, for committee, because I don't believe in surprising anyone. They shouldn't be blindsided. This isn't theater, but they have to come out and state publicly and answer publicly questions and get a record going. And if it's something that demands an investigation, a deeper dive, such as we've had to do on Flint with the water crisis, on the unemployment insurance agency, child welfare agencies, and now most recently on the election, a written report is very appropriate because it leaves behind a record of the work that we did for those who come after us, so that our successors in this rapid turnover of term limits have something to go back to a department and say, you said you were going to fix this the last time an audit came out, and it's still not fixed. Here's what those members interviewed you and you said publicly. Where's the accountability? And so those are some of just kind of the tips or things that I've developed over time. When I started in the Senate, we didn't even have an oversight committee. The House had barely kept one. Now both chambers do. I have a great partner in the House right now, and we split up a lot of the work. Our Auditor General is constitutionally established and has very similar to what you just heard from the previous speaker, but it's right there in the Constitution guaranteeing access to all these records and documents. I work very closely with our Auditor General. He's fantastic. But one of the things that was happening before I was there was the audits were often being just ignored. They get tossed out there, audit came out, and unless there was something really flashy, really interesting that the media caught on or some member caught on that was good for politics, they didn't get brought up. And we have a policy of taking up every audit that has a material finding, and most of the audits that have some sort of remark that's worth at least vetting. And so we take a very aggressive stance, and I think it's really important for the members of the public to know that we are interested and trying to fight these battles for them. I guess I'd end with just saying that, you know, I look at some of the various things the Levin Center put out, which I really appreciate their work and their support, and divide up kind of the issues of oversight into appropriations, bureaucracy issues, legislative process, and reforms to how we do our business. Administration, watching over what's coming down from the executive branch, contracts. The universities in Michigan, our universities are autonomous, but they still, the Auditor General still has authority to review them. It's very, very headbutting on that issue that we're working on that, getting some improvement on that. But the last thing I want to bring up that I think has not been very effectively done, and I'm working closely with our Auditor General to try and open this area up for consideration, is to audit statute effectiveness. Because we all pass bills that are supposed to accomplish a certain thing, and whether that's supposed to accomplish, you know, fuel quality standards, or wetland preservation, or farmland preservation, or higher graduation rates and higher reading rates. But who comes after us and validates that the law is working and producing the results that we intended for it to do? And I think that's an area that, at least in Michigan, we've been shaky on. And I'd really like to see us develop a more robust way of oversight on that issue as well, to be able to come back to our legislative colleagues and say, you know, we thought when we passed this 5, 10, 20 years ago that it was going to produce such and such results, but yet it's not working the way it is. The public hates it. They can't work with it. It doesn't make sense to them. A prime example in Michigan that I can think of right off the top of my head is our unclaimed property process. If you go to Treasury, they have a tremendous webpage. It's very easy. Enter your name. It pops up with every potential unclaimed property that your name or a similar name has within the state Treasury. You can print the form, fill it out online and print it at home to send in. It has to be notarized. They're going to require all these copies of ID and everything. You send all of that in, then they send you another letter back saying, you have to verify who you are. And here's all the things we need. And they're the things you just sent to them. That's how ineffective the law actually is for getting your unclaimed property. It seems like it's going to be really simple and smooth. And then in the end, turns out not to be simple or smooth at all. And those are kind of things I'm very interested in digging into more, along with the other ones I've already mentioned. So I don't want to bore you to death. I appreciate being part of this, and I'm anxious to see oversight done everywhere. It's one of our most important legislative obligations, I believe.
Apropos your comment about how effective are the statutes, and thinking of your professional career there at home, it is sort of the case. You tell agencies by statute to do X, and they will do X until, pardon me, the cows come home, unless you give them other direction.
That's
In
right.
this area of effectiveness, do you differentiate between, did the statutory material achieve the outcome as a different subject matter than the statutory material gave guidance, and yet when we look at the regulations went in a different direction than you thought the statute intended? Do you get into that issue of regulations and how it conforms to apparent legislative intent? Do you have some comments maybe on that, Senator?
Yeah, absolutely. It's such a critical question. I certainly don't know how it is in many other states. I do think that in Michigan and at the federal level, there has been a real tendency over the last 50 years for us to write a bill that says, here's a great idea, just agency promulgate some rules and make this happen. And we walk away. And so there's one of our real problems. We are trying very hard right now through my current leadership in the Senate and through much of my pushing on them to not do as much of that, to be much more specific within the statute itself. So I think that there's a bifurcation to answer your question. Yes, we absolutely have times where we pass a perfectly good law, but we need to go back to the department and say the rules that you've pushed out are not cutting the mustard. They're not getting the job done. Then there's other times where it is absolutely the statute, and we need to look at that and review that standard. Did I lose you?
If I could turn to Mr. Sylvia for a moment, I'm trying to avoid having feedback. Mr. Sylvia, from your perspective dealing with other states, one of the issues in various legislatures has been how governors responded to the pandemic and the exercise of their emergency powers vis-a-vis the role of the legislature in conferring and meeting. Obviously, I think excellent remarks from Governor Baker on this topic. But what do you see of this tension between, in a crisis, the powers of the executive under an emergency statute, the role of the legislature to meet and confer? Do you see this as sort of a tension in our democracy? And you don't need to get specific to your home state, but you've been in this field for 3 decades, so you have some perspective on this issue, I'm sure.
Well, really, quite honestly, I'll be honest, I'm amazed in how well it does work, that these branches can somehow figure out how to work together. I'm familiar with Indiana, West Virginia, and to some degree my home state. But I do think, though there are times in which the lines do become testy, and there are issues that will pop up that will bring about the tension that may exist between the legislative branch and the executive branch. And I don't even want to go into the judicial branch. They're like an island to themselves in many ways, at least in my state, the state of West Virginia. But I think I really haven't encountered, and I know that there's the executive branch when it comes to the governor's emergency powers, that can probably override to some degree what the legislature feels you're impeding on its authority as well. I know that can happen. I don't really get into a lot of that type of analysis, but I do know that it happens. And it happens even when we do the program evaluations, that yes, there are times in which the executive branch really doesn't feel that the legislative branch should be in this area or should be looking at this. When our office was first created, my division was created in 93 and 94, and there was apprehension. The executive branch really did not take to it very well. They were rather apprehensive. In some cases, they were resistant to us looking at them. But over time, I think we won them over, and it appears that that's not been much of an issue. In West Virginia, I think the governor has made some sweeping changes, but I don't see really a lot of disputes or resistance from the legislature during this pandemic. So that would be the best way I can respond to that question.
Very good. Thank you, Mr. Lee. I want to go now to Senator Hackett and then Representative Lehman there in Boston. Senator
Actually,
Hackett?
John, I wanted to comment a little on what you said. I've been in the Ohio legislature for probably 10 plus years. There's always been, an executive legislative fight for power. There always has been, I think so. And in Ohio, we went through a process. Jay's here, he didn't say the same thing, but we went through a process that I really appreciate what Governor Baker said today, because we went through it in Ohio where, and I even told our governor, who I'm good friends with, to say, hey, look, if you were still in the legislature, you would have done the same thing. You would have, and we had given up the right years ago. They had given up the right years ago to give the authority to one person who could react quickly under a pandemic or a natural emergency, et cetera. And so we did pass legislation in Ohio that basically, and the governor still can do it, it just has to be reviewed. And the governor vetoed it. Of course, we overcame his veto, and he's a good guy. But you're always, when you're dealing with governors, and they're good friends, you have egos and things, et cetera, which you're going to deal with all the time. But I just think either at the national level or at the other level, you always have that executive, legislative spat, everybody trying to keep control, et cetera. And we saw that in Ohio. And I think the governor's accepted it. I think everybody should be reviewed. No one's above the law, is what I said. So I just want to make that point. Thank you.
I agree too.
Yeah, thank you, Senator Hackett. Representative Lehman?
Thank you, Mr. Chairman. And maybe to build on Senator Hackett's comments is, you're well aware, and John, you worked in Indiana. If you've been watching the news in Indiana, we took the same path. We passed some constraints. That was vetoed. We overrode the veto. Unfortunately, now our governor is suing us. So it has really raised the bar for this balance of powers, you might say. But so what I'm curious about, though, is are you seeing a trend, or I want to say best practices, but what's happening in these multiple states where you're seeing these challenges now to where when we go back, do we go back to our houses and start to look at, okay, what did Ohio do? What did Indiana do? What did other states do? To find that, I know Kentucky, I've talked to Bart Rowland a couple of times, they had their same fights. Can you talk about, and maybe this goes to Mr. Ike as well, that when you study some of this, what's the best practices in some of these oversights in these multiple states?
Thank you for that question. And just thinking about these best practices, we at the Levin Center have several recommended best practices for state legislatures all across the country. And thinking, especially in response to this classic kind of balance of powers fight that we always see with the governor and the executive branch and their agencies, and then the legislature who needs to have these facts, needs to have this information in order to be as thoughtful in their approach to lawmaking as they can be. And some of the different things that we've seen that have worked in states across the country, and interestingly enough, there really isn't any sort of an immediate correlation between big states being good at oversight or small states being good at oversight, or even really any sort of a partisan balance. It's very often a matter of wills. It's a lot of elected officials at state levels that have really prioritized this and have moved their states forward in positive directions with it, which is exciting as an opportunity for all of us here to be able to do that. Some of the things that we've seen the development of a lot of joint committees of equal membership of both houses, and they will get together and they will, from the start of a session, be able to develop a comprehensive plan for the duration of their entire session. Sometimes oversight can be a little bit too reactionary. There might be a really bad piece of press. There might be some scandal that breaks, and then oversight's necessary. That's a part of this. But having that sort of a broader plan, I do think kind of helps to kind of counterbalance the scales a little bit more versus where we are today. Some of the other things that kind of stick out to me that we've seen across the country, it was discussed by, I think, several of the panelists here discussing this idea of to keep writing and keep putting down the information where you are here and now and the oversight that you are conducting, because whoever comes next, far too often when I was in the Michigan legislature, there would be reports that I would receive in my office, and I just wouldn't really know why we were asking the department to be able to get this information. And I had to really hunt down a lot of previous elected officials to say, hey, do you know the context between why we were doing this? Was there a problem with this before? I'm unsure. And that was where I kind of developed that best practice of being able to make sure you have that information ready to go. So whenever that baton is passed, you have the information to be able to continue to enforce that legislative prerogative. I hope that's a decent answer. There's several other different approaches. I'd be delighted to talk about it further another time.
Thank you very much, Mr. Reike. On this idea that oversight is something to be done on a bipartisan basis, you know, when I look at here in California, I'm a Democrat. We are dominated by the Democratic Party. An awful lot of legislation I do see as what I call sort of spy versus spy. It's one side against the other side. It's very different values kind of battling out in the legislature. Oversight, by contrast, is very much a case of all the lawmakers, both parties are one side of the table, having a conversation with someone in the executive branch on the other side or some other party. I definitely see a bipartisan spirit of oversight, even in my California legislature, where oversight is understood as something we do on behalf of the broad public, and it's really vindicating the prerogative of the institution to be that fact finder, to be the people's house, to ask those questions and ascertain what's going on and bring accountability and balance. It is integral to the whole concept of checks and balances as they exist. I'm looking at the clock. We are at 11:44. We got a late start. I want to thank the panelists for sharing your stories. Mr. Sylvia, for your long work there in West Virginia. Senator Broom describing sort of how you went about coming in as a new member and tapping old expertise, the expertise of your predecessors, and jumping in to make a difference and revitalize this effort. And Ben, I do thank you for your work and your availability. It's just a very important power on behalf of our public. So unless there is any further business at this time.
Mr. Chairman, if I might just add to what you were saying about the bipartisan nature, I'd like to just add that part of, I think, the key to doing this well is to make it a habit. It's something that we should be doing all the time, not when there's just a scandal, not when it's just politically beneficial to one side or the other, but we should be in the habit of doing good oversight in good times and bad, whichever party is in charge. And we should just make it the normal process and part of our work, just like we do budgets and appropriations. Nobody says it's partisan to take up the budget this year because we did one last year too.
Thanks again, Senator McBroom, for the comment.
Yeah. Thank you, Senator McBroom, for the comment. Thank you for that. I will say again, on the NCOIL website, you will find among the materials the CSG West Guide. You will find the California Handbook Guide. And actually, under the Insurance Legislators Foundation part of the website, you'll find a 2007 study on the NCOIL website, a study on state authority making a case for proper insurance oversight. That is also a great resource for this organization. And it just reminds us that's from 2007. So this is a long thread in our history. So with that, I will call this general session on oversight to conclusion. Thank you very much.
Good afternoon. We'll go ahead and call to order the Property and Casualty Insurance Committee meeting of the NCOIL summer meeting. Will's just going to take attendance of the members that are present in the room because we do have a full agenda and we'll be tight on time today. But if we could at this time have any legislators that are participating by Zoom to announce themselves so we can make record of that.
Representative Jim Gooch from Kentucky.
Senator Ken Cooley from California.
If no other legislators, I would entertain a motion to waive the quorum.
I so move. Second.
We have a motion and a second. All in favor?
Aye.
We have waived. The quorum is waived. If I could also entertain a motion to approve the minutes of the April 18 meeting. We have motions and seconds on that. All in favor?
Aye.
Thank you. We will get right into the agenda today. As I said, we do have a full agenda for the committee today, and we want to recognize, be respectful of everyone's time today. We'll go ahead with the first topic, which is property and casualty insurance guarantee funds. What are they? How have they responded to COVID? And how do they interact with captive insurance laws? Presenting at the table today is Roger Schmelzer, President and CEO of the National Conference of Insurance Guarantee Funds, and Barbara Cox, Counsel at NCIGF. The floor is yours, and please proceed.
Now you will. How many times have we heard that over the last year and a half? You're muted. Thank you very much for having us here today. My name is Roger Schmelzer. I'm the President and CEO of the National Conference of Insurance Guarantee Funds. We're the coordinating body for the Property and Casualty Guarantee Fund system. Yesterday at the Life and Health meeting, you heard from our counterpart from NOLGA. And so this is the other side of the house, and I'm very pleased to be joined here today by Barbara Cox, our former general counsel, 25 years at NCIGF, now in private legal practice, and we are very fortunate that she's willing to continue to hang out with us and consult, and she's going to provide you most of the information you're looking for today, and then I will come in at the end and tell you a couple of other things. So thank you. Barbara?
Okay, thank you, Roger. Everybody hear me? So first of all, wanted to start with the basic. What is a guarantee fund? What are guarantee funds? Well, they pay covered claims when an insurance company becomes insolvent and is ordered into liquidation, which does happen sometimes despite everybody's best efforts. They are normally private associations, although a few of them are controlled by insurance departments. They are overseen usually by a board of directors made up of industry members. There are a few public members and legislative appointees, etc. Where's the money come from? Well, generally, three sources: assessments on guarantee fund quote-unquote members, and that is any insurance company writing business in the state is compelled to become a member of the guarantee fund. Those assessments are generally limited to 2% of net direct written premium. Also, they get money from the available assets of the insolvent insurance company, and that's kind of a funny thing. Sometimes you get a lot of money right away. Sometimes you get a little money right away, a lot of money later on. Sometimes you get no money. Sometimes you get 100% of your claim payments at the end of the day. Also, in certain states, there are statutory deposits collected by the insurance department. California has huge workers' comp deposits, which fund a lot of their claims should a workers' comp carrier go down. How many insolvencies? Well, it varies from year to year. And right now we're at around 7 for 2020. We've had up to 21 in a year. And I won't dwell, because we're short on time, about how much fun we had during that era. It was shortly after the September 11th incidents. Reliance Insurance Company went down, the reinsurance dried up. We had a few other huge carriers go down at about the same time. We were getting phone calls at one of our annual meetings. Hey, this one's in liquidation, so that one's in liquidation. So interesting, busy time for all of us, but we all learned a lot, so that was good. Keep in mind, these estates will be open for a while, and the guarantee funds will be handling claims for a while. So just because you see a 7 in 2020 doesn't mean that the guarantee funds aren't busy. There still are some reliance claims open that date back again from 2001. Assessments, those numbers are in billions. There have been up to 1.4 billion in member assessments in any given year. Right now, we're down to about $400 million. So it really varies. It importantly is a post-funded system, meaning the guarantee funds don't collect the money from their members until they need the money to pay the claims. So there's not this situation where you pay a certain amount every year, whether there's insolvency activity or not. Roger calls this just-in-time funding, which is exactly what it is. Capacity, there is plenty of capacity. That slide is not illustrating. The blue line should be way down on the bottom of the chart. We only use a fraction of the capacity that's available for the system. So I have another slide that will illustrate that a little bit better. So since 2001, total payouts have been about 23.4 billion. We've recovered about 17 billion from the insolvent estates. Net assessments were $11 million. So again, there's plenty of money, and we don't have much time today, but if anybody has additional questions about assessment capacity, you can certainly give Roger or I a call or send us an email. We are happy to talk at length about that. Okay, y'all want to know about captives. We at NCIGF don't know a whole lot about captives, and that is because most states have language similar to what is in the Delaware law. No captive insurance company shall be permitted to join or contribute financially to any plan, pool, association, or guarantee or insolvency fund, nor shall any captive benefit from any such plan, pool, association, guarantee fund. So generally, we don't cover those programs. There is an exception in Georgia for certain workers' comp programs. That's one of the things I could talk at length about why that happened, but there's no time for that today, but it was an interesting situation. And with that, I'm going to turn it over to Roger so he can tell you about our future challenges.
Thank you, Barbara. I wanted to also say to you, thank you for the work you've done on guarantee funds over the last year and a half, 2 years. You reauthorized your model act that we helped you write almost 20 years ago. We appreciate that. That was a very big thing for NCIGF to have a national organization recognize what we did and how we do it. There's also an NAIC model, but we like both models, but we really like this one. Also, the work you've done on business transfers and divisions, very important, and that's part of these future challenges that we are talking about. How do you make this? How do you get this to go?
Green button goes forward.
Oh, yeah, look at that. The green button goes forward. Okay, so let me talk about COVID real quick for you. You'll be glad to know, and this was unknown at the outset, how how insurance would fare, how the insurance industry would fare under the pandemic, and what that would mean for the guarantee fund system. And we were all concerned. It was such an unknown situation. Fortunately, there were no failures of any extreme nature, and certainly none that happened due to COVID. The guarantee fund system itself, I'm pleased to say, had absolutely no interruptions in service. Barbara was talking about how just because there's a fewer number of insolvencies, there's still a lot going on in guarantee funds, and nobody stopped doing that work. In fact, if anything, there was probably more work that we were able to do just simply because we were recognizing the challenges that we had. So COVID was not an impact on the guarantee fund system, and more importantly, not on the insurance industry per se. So one of our biggest challenges is keeping the guarantee fund system in an always ready status. Title II of the Dodd-Frank Act assigns the resolution of insurance companies of all sizes to the state guarantee fund system and to the state receivership system. There is no distinguishing feature there that says that in any way that the state system would not handle these failures. In fact, there is an authorization for the FDIC, if the state insurance regulatory system doesn't move quickly enough, to go ahead and petition for a company to be put in liquidation, but the resolution would still take place in the states, which means we have to always be ready. Our members have to have enough staff, enough equipment, all of the security necessary to be able to handle whatever comes their way. So that is, in a system that's very lean, it costs about $80 million a year to run the guarantee fund system. We have to be sure that our members are working smart, that NCIGF is working smart, and that we're prepared to do the work that we are statutorily assigned to do. Here are some of the issues that we have in doing that, though. One is security and data. Data security is the most important objective that we have among several strategic objectives. At the Guarantee Fund System, we spend an enormous amount of time working with our members and at NCIGF to be sure that our system is completely secure. All of these other things that we have to do, it won't matter if we're not secure, and you know most of those arguments. The transition of data is probably the most critical issue facing the guarantee fund system, and it works here with the partnership with regulators. There needs to be as much early involvement as possible with insurance regulators and insurance receivers, but on the regulatory side, so that if a company were to become impaired in one way or another or go into supervision, that we would already have an understanding. We don't want to be involved in the decision about a company going insolvent, but what we do want to do is be able to be prepared for a seamless transition of claims data into the guarantee funds and to the insurance receivers. Everything is digital now, and you may think that makes it easier, but it doesn't. Paper files, some people will tell you they would much rather have, but you know, the pipe, the internet pipe is only so big, and you can only get so much information, and so much is imaged. And so we need to have as much preparation as we possibly can. And we think that we're making some progress on that. That is a change. Probably it's going to have to be statutory in a few states to allow us to be able to do that. New business models. Again, we talked a little bit about divisions and IBTs. You are talking about that here. The insurance environment is very dynamic. You know that. But there are decisions that get made in insurance departments that sometimes you don't know how they're going to come out many years later and how it might affect an insurance company. And we all want to be sure that the industry is doing what it needs to do to serve consumers. We need to make sure that we can do whatever we need to do to protect policyholders in the event that protection is necessary. And so thank you. That's our last slide and the end of our presentation. Can we answer any questions?
Are there any members of the committee who have questions for our presenters? Any legislators on Zoom? Seeing none, we appreciate you being with us, and we thank you for your time, and thank you for being a resource to NCOIL.
Thank you.
Thank you for your support.
Second item on the agenda will be developments in post-disaster claims handling legislation. Presenting on that will be Amy Bach, Executive Director of United Policyholders, and Representative Pam Marsh, Chair of the Oregon House Committee on Energy and Environment. Are they remotely? Yeah, they're on Zoom. Okay, and they'll both be remote. So when you're ready, ladies, you may proceed.
Thank you so much. We really appreciate this opportunity to share information with you. Representative Marsh is with us. And so we're just going to jump right in, and hi, Ken, wherever you are. So our topic today, improving disaster recovery through insurance reform legislation. We can go to the next slide, and we are mindful of the time. Representative Marsh, if you want to give greeting.
Happy to be here with all of you, even in this virtual forum.
Great. Okay. So as you can see, let's see, what happened to the share? It's on there. I've got to do a little different pin here. Okay. As you can see, Representative Marsh, this is a snapshot from her website. She curated resources for her wildfire impacted constituents. Did we skip the slide that gave the credentials of the Rep Marsh? There we go. There she is. Her district was heavily impacted by 2020 wildfires. She chairs the House on Energy and Environment in her state, and has been vice chair of a special committee on wildfire recovery. Next slide, please. And as I was saying earlier, she has been very hands-on in her district with the impacted constituents and aggregating resources. And a lot of her focus has been on assisting manufactured and mobile home residents. Rep Marsh was I think of the, it's like 2,800 homes, a very significant number were manufactured. Is that right?
Yeah, just to orient, my district is in Southern Oregon, just above the California border, and we were part of the fires that coursed through our state on September 8th of last year. In my little tiny legislative district, that fire took 2,500 housing units, and of those, 1,500 were manufactured homes, a total of 18 parks that were largely or fully destroyed in that. And particularly significant because those manufactured home parks are the places where our most vulnerable residents live, our elders, our working people, and our Latino Latinx population.
Next slide, please. So that's me. I have had the honor of presenting before NCOIL in the past. I've been an insurance consumer advocate since 1984, and I'm the co-founder of the national nonprofit United Policyholders, also a active at the NAIC as a consumer rep, and serve on the Federal Advisory Committee on Insurance, where I co-chair a protection gap subcommittee with a reinsurance executive. Next slide, please. My organization is a 501c3. We're celebrating our 30th year of service. And through our Roadmap to Recovery program, we connected with Rep Marsh because we educate, support, and survey disaster impacted communities and individuals. And so together we have done some education programs, and we also, I helped out on the legislation because through our advocacy and action program, we also support legislative and regulatory reforms that improve loss recovery and uphold the indemnification purpose of insurance. Next slide, please. So Rep Marsh, if you want to just touch on the context and experience that compelled you to carry the bill that we are reviewing today.
Thank you, Amy. Yes. You know, we recognize here in the West that wildfires are really our existential crisis in the future, but I realize that's not the case in all parts of the country, and many of the disasters that FEMA has come into, certainly in the past, are quite different. The floods, hurricanes leave a community in under different conditions. In the cases of these wildfires, what we had left was nothing. What we had left was acreage of debris. And what that meant is that the entire community, instead of being able to do any kind of repair, and that's a condition that FEMA more normally addresses, this is all about a rebuilding process, and it's about a very extended rebuilding process. We are a community that was already hard hit by the lack of construction workforce, With the pandemic, materials skyrocketed all across the country. Probably all of you have heard about that from yourselves or your constituents. So we faced a situation where we were going to have to do widespread debris cleanup in partnership with FEMA. We were looking at significant delays in issuing permits. And immediately people got off those insurance policies and they started to say, oh my God, I have 1 year to rebuild my house. How am I possibly going to pull that off? Certainly under the best of conditions, if your house burns down and you have your house plans in a safety deposit box and your daughter-in-law is a contractor, maybe you can rebuild in a year. Under conditions that we were facing with large spread disaster, it was simply impossible. So it was from the very beginning of that disaster as it unfolded that we realized that our conditions on the ground really mandated a different approach in insurance policies, and that initiated the legislation that we did as a result.
And we've got a note here that insurers' application of depreciation is particularly problematic for manufactured homeowners. We did not, the bill does not address that, but that's something I'm throwing out there to your members because it is a significant consideration. So the next slide. So you already heard some of these, and we are mindful of time here, so we're going to try to condense a little bit. We've already talked, you heard Rep. Marsh talk about the challenges of there being a lot of homes destroyed with limited resources, but there's also the reality that company and independent adjusters are stretched thin after large scale disasters. Training and experience varies. And there's the use by insurers of Xactimate software to calculate their offers, their settlement offers on dwelling claims is a chronic source of dispute because builders price differently. They don't use Xactimate, they use sub bids. So we have that issue. And then underinsurance, very, very prevalent. So in addition to the concern that Rep. Marsh identified of people realizing that there was no way they're going to rebuild within a year and needing more of additional living expense coverage or longer, there's also this problem that Rep. Marsh and the legislature took aim at in the bill that we're going to quickly review. Just trying to reform, it's sort of building on some of what we've tried to do in California through regulation, is trying to get insurers to do a better job at working with their customers to insure dwellings to their true replacement value at the point of sale. So another reality in the lay of the post-wildfire land is that we have not really seen insurers be willing to adopt across the board voluntarily special rules to expedite disaster claims. And so we've seen some legislatures like California, Colorado, and now Oregon sort of through legislation compelling a certain amount of a disaster claim is a little different from a one-off. And so as you heard from Representative Marsh, it's 12 months of additional living expense is not enough for people to get them to where they can move back into a replacement home. Next slide, please. So you can see that my organization, part of what we do these surveys, and these surveys document over and over that wildfire survivors are chronically underinsured. So only 18% of people who lost their homes in last fall's wildfires in Colorado said they had enough insurance to cover rebuilding. And then only 23% in California, same stat. So we definitely have a very severe problem on our hands, which I have presented on to the NAIC over the years. I've probably presented to NCOIL as well. Next slide, please. And again, it doesn't matter really where the disaster hits. Dwellings are not adequately insured. I don't think that's news to a lot of you, but it is pretty compelling. And I'll tell you the approach that Rep. Marsh took in her bill, and we can keep going. Next slide, please. This really is just an illustration that 12 months is just not realistic to expect people to replace their dwelling after a wildfire. And in fact, I was 1 year after the Camp Fire in Paradise, less than a third of the impacted people had been offered full settlement on their dwelling at the 1 year. Next slide, please. And just one last bit from our surveys. When people have been asked, what are your biggest sources of post-fire stress, insurance claims come up way too high. So what we are looking to do here, what Rep. Marsh did, what I think we would love to see all of you do in your states, is to work with insurers either on a voluntary agreement basis or through legislation to reduce the stress and make the process not so challenging for overwhelmed and traumatized people who have lost everything. Next slide, please. So what the Oregon legislature and what California has done, and a little bit Colorado, is to extend policy deadlines to be more realistic and factor in the extraordinary circumstances, to reduce the prevalence and impact of inadequate insurance limits, to give survivors some flexibility, to use policy benefits to replace their homes elsewhere, which helps get people out of wildland urban interface zones. And then we'd like to see more innovation reform in reducing the requirements that people list every single item in their medicine cabinet and in every kitchen drawer in order to settle their contents claim. Next slide, please. So Rep. Marsh shows some highlights of your bill, House Bill 3272, if you want to just recap these. I think you're on mute.
No, I'm not. The heart of the bill was really to address the timelines that were endemic among the consumers who were holding insurance policies. And those have to do with that rebuilding issue that I mentioned earlier. Quite typically, people looked at their policies and saw that they had 1 year to rebuild. The state asked people to extend, some insurance companies did. And to be clear, many insurance companies were very helpful and people are praising them in the after fire experience, but that actually made it all the more difficult when we started to hear stories about insurance companies really not stepping up in a way that they weren't obligated to. So the heart of the bill is really to extend that replacement timeline. The way the legislation reads is now an individual whose home burns down in a single event. So your house is the only house on the block that burned down. You'll have 2 years to rebuild. Up to 2 years to rebuild. You have the option with your 1 year limit of asking for 2 6-month extensions. So if you have extenuating circumstances, you can't get a contractor, materials aren't available, you can extend for 6 months and then for another 6 months for a maximum of 2 years. In the cases where an emergency has been declared, you have a minimum of 2 years to rebuild and the option of 2 6-month extensions. So a potential of 3 years if, again, you are facing extenuating circumstances. And along with that, we also ask that living expenses in the case of an emergency situation be extended subject to the limits of the policy. So that was really the heart and the most important takeaway for most of the people that we were responding to.
Okay, we can go to the next slide. I'm sorry, I hope I didn't cut you off there, Rep. Marsh.
Well, the other, I'm trying to, my slide is very small on the screen, so I'm looking at other places to remember to make sure that we're covering everything that we wanted to share. The other benefits in the bill in terms of rebuilding, in addition to the timeline, were the ability to combine coverage. So if you have a studio out back or a 1-room accessory unit, and you don't have enough coverage within your policy to rebuild your primary home, you can combine the coverage and use that studio or the outlying buildings in the construction of your existing home. That was an issue we're going to see come up in this case, although this bill is not, unfortunately, retroactive. Though the cost of materials and the cost of construction, and when you're competing against a whole lot of other people who have had losses, those costs accelerate, not unsurprisingly. So combined coverage was an important piece here. And then the last piece of coverage was really to allow you to, and Amy referred to this earlier, allow you to rebuild in that location where you are, or to rebuild in a different location, or to purchase a home in a different location. We found that in some cases, people just had to start their lives over again. They did not have the psychological ability to stay in place, or in many cases, the logistical ability to work through a rebuild. So they needed to buy someplace else, go someplace else, continue their lives. And we made that possible through the legislation.
And that is I'm hoping that by presenting here today, we are helping spark kind of a national trend that all states allow these levels of flexibility. They don't cost the insurers more than they would otherwise pay if the homeowner were to rebuild, and they are practical. Rep. Marsh, did you try to have your bill have retroactive application?
We were working with the insurance companies and Department of Insurance. Department of Insurance had asked people, again, asked many of the companies to voluntarily take on some of these policy changes, and many did. We recognized, though, that we needed to start at the beginning of a policy period, so we did not try to make it retroactive.
Okay, next slide, please. And so on the effort to try to reduce the frequency and severity of people finding out after the fact that their dwelling is not properly insured, you took an approach that is somewhat similar to what California has done, which is to mandate that that when an insurer does that replacement cost estimate at the point of sale, that it be comprehensive and that it include all the main cost drivers. California lists them. Your bill and your new law basically just invites or gives the consumer the opportunity to get their insurer to do that estimate. Is that correct?
That's right. We, we know we can't obligate people to buy more coverage. And we also know that given what we've seen, that every one of us should be running out and calling up our insurance company to figure out how far our coverage is from what we have to what we need. So what we are trying to do here is simply to spur thought about it, to spur consumers to be reaching out to their insurance companies before the disaster hits.
Next slide, please. So we just compared the Oregon to the California law, and this PowerPoint, of course, will be available to everyone who's participating today. Next slide, please. So we've already reviewed all of this substance. This is really just for to give you the statutory references in the two states to compare. They're very similar in the approach, which I think makes sense. You know, it's much easier for adjusters to deal with similar sets of rules in different states. And so it would be, I think, very helpful if all wildfire-prone states were to have these flexibility rules in place and these extensions in place. Next slide, please. Keep going. And I think that's it for the substance. We wanted to zip through. We knew you were a little behind. So if there are any questions for Representative Marsh or myself, we will be more than happy to answer them.
And Amy, I might just add a quick comment, which, as I mentioned earlier, we worked with the Department of Insurance, which got on board with the bill, was supportive of it. The governor was supportive of it. But we also had really positive working relationship with the representatives from the industry. They didn't endorse the bill, but they also agreed not to oppose it, because I think they realize that these are pragmatic reforms that really reflect the conditions we are seeing on the ground, and it was a way for them to step up and really do something good for consumers as part of that relationship. So I think they deserve a lot of credit for being there for us when we needed them.
Yeah, and I think, you know, as Assemblymember Cooley knows from California, some of these reforms that got put into legislation started with a voluntary agreement that that Commissioner Poizner had negotiated many years ago, and then insurers found they could live with the reforms, and so then they kind of proceeded to legislation. But yeah. We tried. I think, you know, the idea here is not to impose onerous requirements on insurers that are going to make it harder for them to do business, particularly in light of their legitimate concerns about increased risk due to climate change. So I think keeping a good balance is the right approach. I think this bill has a healthy balance.
Thank you, ladies, for the presentation. Do we have any questions or comments from members either in the room or on Zoom?
Well, this is Ken Cooley. I'll just jump in. United policyholders grew out of the Oakland Hills firestorm of 1991, which was shocking at the time, now much superseded. And her experience then continues with the organization into the fires that ensued in the following years in Southern California, the LA Basin, and then the Northridge earthquake. So United policyholders have been very active in California since the early 1990s.
And it's been our honor to work with you, Assembly member, especially because I know you have a very deep understanding of insurance marketplace forces, and that has been helpful.
Senator Felskowski.
So I apologize. I mean, it's a little muffled as you're speaking, but my one concern and my question is you're going in and you're legislating this, you're basically altering these insurance contracts and you're saying, well, now you could include coverage B for coverage A, and you're going to pay an additional up to 24 months on loss of use on a homeowner's. Are you at all concerned on the actuarial that goes along with that and whether companies are going to be able to sustain that in these situations, or how do you address that issue?
Well, I'll start, I guess, unless Rep. Marsh, unless you want to go.
I'll jump in. Go ahead.
Okay. The Oregon bill doesn't mandate additional so much dollar amounts so much as additional time. So it doesn't say that the insurer has to provide a higher dollar limit of ALE. They just have to make that dollar limit available for a longer period of time is one. And I guess the other answer is that insurers did not seem to have any problem adjusting to a whole series of reforms that were implemented in California over the years by adjusting their rates. And because it's not retroactive and primarily relates to giving the policyholder just more time and flexibility, not necessarily more money, it doesn't seem like it has had a problematic impact on rates. I mean, other than the problematic impact that all these wildfires are having.
And this is Pam. I'll jump in with a couple comments. I think it was very reassuring to know that California had preceded us with these reforms and been able to sustain those reforms and maintain coverage. We also knew that many insurance companies offer one or another of the reforms that we were proposing. And so what we were trying to do is really establish a baseline across all companies. So there was really no question that a consumer would get adequate time to rebuild or to cover their expenses or to rebuild, the ability to rebuild in a different location. But we know insurance companies are already doing these things in many cases. And still, even though wildfire loss is huge, across the state, the experience of loss is still quite minimal if you look at the full docket of insurance policy coverage. So the importance of really having adequate coverage for a person when they're at the worst moment of their lives, when they are absolutely in crisis, seemed much more compelling to the legislature than worrying about whether or not there might be some impact on price down the road. And I would note that this legislation was highly bipartisan. I'm not sure that we even had a handful of legislators in opposition.
Okay, we have two more legislators and then we'll wrap up this topic. First will be Representative Lehman.
Thank you. One concern I guess I would have, and I wouldn't know how you address this in Oregon, is we already, as a broker, we already have a struggle with getting people to insure at an adequate limit. So you began your presentation by showing the number of people who were uninsured at the time of a loss. Majority of those that I see today are their decision to underinsure. We've pushed for higher limits. They've chosen a lower limit because they think they're overinsured until they have a loss. Does this not encourage underinsuring if I know I can simply pull my other coverages over if I need them? Did that get addressed at all? Because I would think that'd be a concern with, I can take my coverage B 30,000, underinsure by 30, knowing I'm always going to get that extra 30. And it kind of goes to the contract issue, is I think it disrupts that claim. So I'm just curious how you address that, I mean, no one's forcing people to underinsure. If anything, the carriers today are moving in the opposite direction in what we've seen in Indiana. So I'm just curious how you address that in Oregon.
Well, and one part of I think certainly getting people to have the right kind of coverage is an important goal for all of us. And that was the objective of that component of the bill that requires insurance companies to offer consumers at every other renewal some basic information about what it would really cost to replace their home. So that's part of the objective. We did discuss with insurance companies. We had a little bit of pushback on the question of combined coverage, whether or not you could combine your outlying building with your main building. But the idea that someone would be so calculating as to think, in the case of a full wildfire, when everything on my property is destroyed, I'll be able to use that coverage from an outlying building with the main building, I think just doesn't hold water in terms of the consumer's approach to it. I think there are very few consumers who are going to assume that everything on their property is going to be burned down in a wildfire. More likely, they're going to have a kitchen fire and their house is going to burn down, and they're not going to have any combined coverage to draw upon in a case like that. So I think when we sat down and talked it through with the companies, there just wasn't enough there to worry about.
Thank you. And the last quick comment or question will be from Senator Hackett.
And actually, Matt asked the first part. Second part it's for Pam or Ken to answer is you said it's not going to be retroactive. So the insurance industry then just would, they pay premiums. And so if you expand the coverages to allow them additional coverages, then, the premiums would be expanded, but they still have to get the premium increases through the Department of Insurance in California. So what's the experience been? Is the Department of Insurance played hardball with them? I mean, how's it happened?
In California?
Yeah.
I think back across the years, definitely they played hardball, and that's been part of it's taken a lot of conversation back and forth, Senator Hackett. The change of California to the elected insurance commissioner has impacted a lot of the entire regulatory environment and certainly the post-disaster environment. So it has been a challenging time, and sometimes we actually had an insurance commissioner that got into trouble because he crossed some lines he shouldn't have in some post-disaster conversations in terms of playing hardball. But there's vigorous advocacy on both sides. But it is often the case that once it gets resolved, it has been resolved fairly amicably in the legislature.
And I know you didn't ask me, but my understanding is that 91% of the rate increase applications that have come in since the campfire at Paradise have been approved. So I think that the process is working somewhat well, I'd say, for the insurers, although it's not perfect, of course, as Assemblyman Cooley referenced.
Thank you all again for your presentation and your participation today by Zoom. And it was a good discussion on a very interesting topic. But we do need to move along to item number 4 on the agenda, which is going to be an update on NCOIL Fairness for Responsible Drivers Model Act. Senator Sean Vita is a sponsor, and he will update us on where we are in that process.
Thank you, Mr. Chairman. I'll be very brief. I just wanted to provide the committee with an update on this model, which is in your binders on page 329. As I stated to the committee at its last meeting in April. The model is intended to be viewed as the next step in support of the no pay, no play laws, which NCOIL adopted a resolution in support of in 2014. The model and the laws in the approximately 10 states that have similar laws, including my home state of North Dakota, prohibits uninsured drivers from collecting the benefits of a system in which they do not participate. Specifically, the model, subject to certain exceptions, prohibits a person or personal representative of a person who was an uninsured motorist and who sustained bodily injury or property damage as a result of a motor vehicle accident from recovering non-economic damages from the person's bodily injury or property damage or death. The discussion of the model in Charleston generated a vigorous dialogue among committee members, and while such a dialogue is extremely healthy and is what our committee meetings are intended for, I believe it rose to a level where it indicated that we are far from reaching the level of consensus needed to move the model forward in a meaningful way. Accordingly, following the April meeting, I directed staff to research the relationship between the level of penalties for driving uninsured with a state's uninsured motorist population, as well as the cost of those penalties versus the cost of compliance, which with an eye towards taking a step back and examining the overall issue of uninsured motorists knowingly driving uninsured. That research is before you. There's a handout, state by state penalties for driving uninsured. And I will be discussing the research with staff and to discuss what the best steps are for the model. So for now, the model and issue are on pause, so to speak. And I look forward to having them back on the agenda at the committee's next meeting in November for an update. One query I propose for the committee to consider is if the problem we're looking to address is reducing the percentage of uninsured motorist population, should statutory penalties for driving uninsured simply be increased? I ask that you consider that question between now and November, and please reach out to me and staff with any suggestions or comments as to what the best path forward and the approach should be. Thank you, Mr. Chairman.
Thank you, Senator. Any questions or comments from members of the committee at this time? If not, we'll look forward to hearing from you on the topic again in November. Next item on the agenda will be item number 5, and that's discussion on warranty legislative and regulatory landscape. That will be Greg Mitchell with Frost Brown Todd and Eric Arnum, editor of Warranty Week. Gentlemen, if you would, introduce yourselves for the record, and you may proceed with your presentation.
Thank you and good afternoon. My name is Greg Mitchell. I'm chair of the insurance industry group at Frost Brown Todd, and with me is Eric Arnum, editor of Warranty Week. We're very much privileged to have been asked to provide an introduction and overview of warranty legislative and regulatory landscape, which could be a very deep subject, and we'll try to provide it to a level of understanding, looking at really from a consumer and the market's perspective. See if I can figure out how to work this. Well, somebody might have to help me, but.
Oh, there we go.
There it goes. All right. So just in simple terms, I'll take something as perspective of, without picking on Apple, here's an Apple iPhone. So with an Apple iPhone, it comes with a warranty. Apple provides an express limited warranty provided under our Uniform Commercial Code, which is a law in all of our respective states. That's what provides for the manufacturer the distribution channel of what that manufacturer distribution channel promises will be the performance, merchantability, fitness for purpose of how that good product will operate once it's in the consumer or the business's hands. What has evolved over a period of time has been the development of basically third parties that have looked at what has developed in the world of warranties and has developed additional services and benefits of which has been provided by third parties, and i.e., we start to creep over into the world of insurance. What has developed in the regulatory landscape, because it would very, very much be impractical in this world of insurance and insurance regulation in dealing with a service contract, extended warranty, with the full provisions of insurance. So back in approximately 1995, the NAIC, with some industry development, created the first Model Act, NAIC Model Act, that basically provided a carve-out of the definition of insurance. So as we look across the landscape, and in the slides, we'll have a kind of an overview of kind of state-by-state approaches that a number of states adopted the model, but a number of states have taken all kind of different variations from Indiana, which is done by bulletin, a carve out of insurance, to other states that have very in-depth regulation and statutory provisions, a lot of which are regulated by the departments of insurance, just like on the insurance side. So it runs the gamut, but it in principle stands for, it's for separately stated consideration and for a separate time period. And so there's a lot of creativity and a lot of benefit of which consumers have by virtue of the development of what we refer to as extended warranty or service contracts. Get into that a little bit better. But what translates that kind of, we refer to it as quasi-insurance because of the carve-out. What changes that from an extended warranty or service contract regulated product to a world of insurance? So if we take that same element and we say Apple provides the warranty, Apple actually provides their own extended warranty service contract, so you can pay an additional statement of consideration by Apple, of which they'll then cover across their warranty for different provisions that will fill the gaps of which the warranty doesn't cover, that you can then do by extended warranty to provide additional benefits that you may, as a consumer or small business, want to include. If we add into the contractual language that the consumer small business receives loss and theft, we now switch it over to the world of insurance. And all of these provisions really depend upon what is in that piece of paper that's handed over. That's the world we live in of what are the details, what are you saying, what are you promising to your customer that will develop as to where it fits in this regulatory landscape. Well, let me try it. There we go. So as we kind of break down where we fall from policymakers' decision of where states have gone about, on the warranty side, you know, an OEM, your car manufacturer provides a warranty, your manufacturer refrigerator provides a warranty. Two-party, the consideration is part of that purchase of that good. Simple, it's uniform. We come over the world of extended warranty service contracts. We now start to break down of where do we want to have financial responsibility? Where do we want to have perhaps reserves set aside for what those future losses may be on the benefits you've promised in the future? Where may you want to then have disclosures provided to the consumer or the small business? Where may you want to have other regulatory provisions, including, as a few states have adopted, on licensing of sellers? So as you can see, it kind of runs from insurance light to getting really, really close to being regulated as an insurance product, as would be referred to primarily in California and Florida. And then we get over into the world of insurance, where we start to add benefits that have and are triggered by fortuitous events. That is risk dispersion, risk distribution, where you're spreading that transfer of risk and you're providing benefits which are outside of the term of the extended warranty service contract. And I have to caveat that because as the laws have developed and continue to develop down these different industries, you start to see creep of what is allowed to be offered, whether it's accidental damage from handling. It's not the product, it's simply you drop the iPhone in the toilet, as may happen, or other things where you start to pick that up in this middle regulatory silo versus what would be in some other considerations be considered to be an insurance product, i.e. triggered by a fortuitous event. I dropped it in the toilet, didn't expect it, didn't want to have it. Maybe I could prevent it, maybe not. And you start to see a lot of evolution depending upon what state we're talking about down through that cycle. So I'm going to pass a few slides so we provide some time. So really kind of breaks down in multiple cycles, and Eric will go into a little bit more about where we see of how the industry has evolved and substantial use and continually reception by the consuming public, whether a consumer, household, whether it's a small business, into a couple of different channels. One of which is obviously consumer products. And for the most part, they're regulated kind of in their own window. They have different businesses that have arisen that support that part of the industry segment. It may include, like I said, Apple would fall on the consumer side. Apple could fall also across the spectrum on the business-to-business side, where the company may buy 100 iPhones, or might be Samsung, or you pick your company that may do it, and all of a sudden it's a business-to-business contract. Then you have a whole different cycle on the home warranties. A number of states regulate that separately, separate from the consumer side, and then a whole totally separate industry really on the vehicle service contracts, down through the OEM manufacturers like Toyota, Nissan, Porsche, and others are going down through. And now we're seeing a development of the industry, like on the vehicle service contracts for previously owned car, so it'll be certified previously owned automobile. You'll put a warranty over top of that. You may then add and sell the consumer an additional extended warranty for a separately stated consideration up and above that, separate from the purchase price. And so you can see you can have multiple products regulated differently. From the consumer's perspective, they don't understand the back end. It's the front end of the regulation, the policy-making decision that really depends upon kind of how everything's laid out and how effectively it's working. Then we switch, as we've seen a lot of development over the last at least decade, on business to business, where businesses as well as family and households want to have basically holistic approaches to service. Let's just say I'm a big company. I have a whole bunch of warehouses, and I have big chilling HVAC system sitting on the top of my roof. Maybe I want to outsource that. I want to enter into a service contract with some company that will be responsible for making sure those HVACs on those warehouses are operating efficiently and in use at all times. So you can see how it will devolve into the world of business to business. In the area of business to business, a number of states, when they developed the model law, there was footnotes or notes of drafting of where the statute simply carved out consumer products, or where it totally carved out the entire area of service contracts. And so some areas and some states respectively, we still have the issue of the B2B could be considered to be an insurance product. And it says, it gets a little complex. It's a world we live in, but it is one of which I think over this past year and a half, as COVID's indicated, consumers are really relying upon products such as these for the holistic approach, getting service, knowing what to do, what's covered, transferring the risk just like any other type of third-party transfer. This is just a general slide that talks about kind of the overlay of players in the world of extended warranties. Same with warranty, we have a manufacturer, you got the customer, administrators, similar to like a third-party administrator on the health side and insurance, sellers, obligors, some states refer to them as providers, and then this also is still in the world of insurance, because when we talked about financial responsibility, the states that have chosen to regulate, license, there are varying degrees of financial security requirements which are present. So if I go back up to, there we go, so we get to varying degrees of financial responsibility. A lot of states have developed, Indiana used by Bulletin, is if you have a contractual liability policy, that is a policy of insurance that an insurer, licensed, admitted, some cases excess or surplus, has issued, that insurer will stand behind all of the contracts that the obligor or provider has entered into, then it will be carved out of that insurance regulation. Obviously, the Department of Insurance will still regulate that CLIP or contractual liability insurance policy. And then the various forms of policy provisions, whether it's required to cover the first dollar, that is, the carrier will be on the hook for the first at the beginning. Most states have where the carrier is responsible after they've attempted to have their service or their repair or whatever was promised in the piece of paper covered by the obligor, and if they don't after 60 days, then that carrier is responsible to pick up on the back end so that the consumer, the small business, actually gets covered. Other states have provisions such as funded reserve accounts, where you treat much like a reserve from an insurance company based on ratios of how much funded reserve of contracts that are open and still in force. Others have various forms of deposit and reporting requirements. A number of states are indicated here also require companies to file their terms and condition, either for review and approval, so that the agency will review those, approve them if they comply with the regulatory structure in their state. Others, it's file and use. You file them, they're on record. It runs the gamut, as you can see. And this is just a high-level overview, kind of across the board. It does not even deal with differences when you break down the variations of the industries between the consumer product channel, the home warranty channel, and then with the vehicle service contract channel. They each can take their own distinct regulatory differential depending upon what respective state we're talking about. As I personally have seen over the evolution of development, it has gone from the point of view of companies thinking it's additional revenue source, i.e. that additional consideration that's required, to like companies like Apple, Microsoft, others, where it really is customer service. It's that providing the customer the very good benefit of making sure at all times, whatever that product is they've purchased will be operating and functioning to their benefit. And so it's looked at more of the overall consumer experience than it has with respect to simply normal, I paid, I've got a contract, I'll pay claims, but really is part of their overall business strategy. With that, I'll pass it over to Eric to provide some real detail on the metrics.
Thank you very much, Greg, and thanks to all of you for being here. I'm going to fly through a whole bunch of statistics and numbers. It may be like drinking out of a fire hose, so forgive me for doing that. But I have provided copies of all of these slides to both Will and to Tess, so you can take home copies if you need to, and you can call me if you need a deeper explanation. What we're looking at here is the dashboard for product warranties from 2003 to 2020. I'll just give you the latest. Warranty claims in 2020, $23.8 billion. That was down around 8% from 2019. Warranty accruals fell by only about 1% to $24.6 billion. Warranty reserves, which is the balance in the fund, rose surprisingly to around $47.6 billion. The important number I want you to take away from here is in the lower left-hand corner, warranted products sold. This is the amount of products sold worldwide by these companies that report their warranty expenses. It fell by $200 billion in 2020 to $1.7 trillion. So that is the sector of the economy covered by product warranties. Now let's skip to extended warranties and service contracts. I should mention the slide before is based on Securities and Exchange Commission 10K and 10Q financial reports and annual reports. Here we're looking at estimates from Warranty Week, the industry newsletter. But these estimates are also based on hard numbers coming from some of these companies, and I'll show you some of those in a second. What I want to point out to you here is that we're looking at 8 different sectors of the consumer portion that Greg was talking about. In 2020, 5 were up and 3 were down. The ones that were up are consumer appliances, consumer electronics, mobile phones, home warranties, and personal computers, home computers. The 3 that were down were vehicle service contracts, jewelry, and furniture. And now let me just jump into that a little bit deeper. The total in 2020 this is money spent by consumers on extended warranties in the United States, $47.7 billion. That was down fractionally, around 0.6% from 2019. But if I can jump back for a second, you can see clearly that 2019 was the peak for the industry. So 2018, 2019, 2020, seems like we're on a plateau right now. Here's the share. It's a little hard to read, but I'll tell you that the vehicle service contracts is the bulk of the industry. That's $16.5 billion, followed by mobile phones. Mobile phone, as Greg was mentioning, sold by mainly the phone companies. That was around $11 billion. And then consumer electronics is up at the top, but a lot of that is also mobile phones. So if you took the mobile phones sold by the phone companies, sold by Best Buy, sold by Apple, sold by the others, and you add in the vehicle service contracts, you have around 2/3 of the whole pie there. Jewelry was $2.6 billion, home warranties around $3 billion, appliances as sold by Sears or Home Depot or Lowe's was $1.75 billion, and furniture $1.15 billion. These are my estimates for the industry for last year. But the point I want to make to you is that although it did fall a bit, it was really only a little bit. And what I'm about to show you is numbers coming from the companies themselves. This is Lowe's companies, obviously a very large retailer of hardware, appliances, lumber, not so much electronics, what do I mean? Lighting, power tools, electrical, and what have you, gardening supplies. They sell a whole lot of extended warranties as well. And what you can see there for the second quarter of 2020, when we were all in lockdown, they set a record for revenue on extended warranties, $167 million. That's the second quarter of 2020. That's the months of, oh wait, they're a little staggered, so it would be May, June, and July of 2020. $167 million, a new record. They certainly didn't say anything about that in the press. You know, as we're all locked down, we're setting new records for extended warranties, but that's the truth there. That's the math, straight out of their books. American Home Shield. This is the home warranty. This is the 500-pound gorilla of the home warranty industry. American Home Shield, they have almost half the market to themselves. And what you see there is a gradually rising seasonal pattern. There's no mistake to it. You're looking at 2018, 2016, 17, 18, 19, and 2020. It's gradually rising, and it's seasonal. They have 2 good quarters followed by 2 slow quarters, followed by 2 good quarters, followed by 2 slow quarters. It's a very clear pattern, but the point I want to make is that it's gradually rising over time. There is no recession on that chart. American Home Shield in 2020 reported $1.47 billion in revenue on home warranties. That was up 8% last year. And then one more I want to show you, Assurant Incorporated, very large insurance company. They do both the consumer brown goods, white goods, appliances, electronics. What we're looking at here is just the automotive part of Assurant. The jump from where they were in 2016, 2017 to where they ended up in 2019 and 2020 was mainly because of the acquisition of the warranty group. And the addition of that revenue, which was very heavily automotive, boosted them up to the point that they're at now. But what you can see there, once again, in quarter by quarter, going back 2.5 years, is gradually rising revenue, leading to what you see in 2020, in the second half of 2020, again, record revenue. Now this is net earned premium, fees and other, in case you want to verify this by looking at their financial statements. In 2020, they reported $3.1 billion in net earned premium, and that was up 8%. So as I said, you can get copies of these slides. If you need any deeper explanations about them, please contact me or Greg. There's a phone, email, and I don't know, do we have any additional comments, or we'll open it up to questions, comments?
I think questions. We also provided some background material, some selected statutes, just to see some differences in how different states treat different regulation, as well as the NAIC's Model Act back in 1995.
Thank you all. I appreciate the presentation, and it makes a lot of sense to me. I now finally understand why I've been getting all those phone calls on my cell phone about my vehicle's extended warranty. It's because their sales were off in 2020. So we'll take some quick questions, and then we'll move on to the last agenda item. I believe Representative Lehman has a question or comment.
Thank you, Chair. Thank you for being here, Greg. And I guess the question a little bit is, when we think of insurance, it is a highly regulated industry. Obviously, warranties are not, because they're carved out. Are we wanting to bring that in because there's a deficiency? And is this complaint driven? Is this what? I mean, I look and think, I bought a DVD holder, and when I checked out, I asked if I wanted a service plan with that for like $3. Well, no, I don't want a service plan. It cost me $8. I'm not spending $3 for a service plan. But the question bigger was, do I want the Department of Insurance regulating that? And so I think, where's the balance here of warranties are not insurance products? They dance that line, but are we creating a regulatory format for products that really are just going to be more problematic in a way to regulate than actually allowing them to do what they've been doing?
Well, I guess I could say personally, we've been asked to provide kind of an historical overview and an overlay. I'll leave that for you as to policy of where regulation should fall. Like I mentioned, Indiana has carved extended warranty service contracts out by bulletin. I'll leave that to you if that's appropriate. What complaints and what static there is in the Indiana market. It's probably a question for the Department of Insurance. But, some things are working very well. And we've got different segments, from the consumer segment to the vehicle segment to the home warranty segment. They all kind of have their own different players, their different operations. The back end, a number of the carriers have what we refer to as obligors. They actually are on the contract themselves, and they will have administrators, so they will administer those. So there's some kind of pulling it into the insurance channel. But, I'll be the first to admit the regulation varies dramatically from states that do not regulate at all to states like Indiana that it's by a simple bulletin, as long as you've got a contractual liability policy in place, to states like California and Florida that regulate it, almost as though it is an insurance product. And in Florida, it's regulated by the OIR, and in California, it breaks down. Some of it's regulated by by the California Department, and the consumer side, it's regulated by their Bureau of Household Goods and Services. So it varies. And just with any product area and areas, you'll have good players and bad players. Where that line of regulation, I know it's very complex. Most of the time where, we look for guidance is just that, guidance, so that when we're building products, we try to build them in a compliant manner. I started, I'm showing my age. I know probably 25 years ago when the handhelds were, like a big piece of brick, and built the first extended warranty coverage where we really didn't have law. And so, how do you tell business, how do you develop something that consumers were asking for? And then if you put loss and theft on it, you couldn't have somebody that's a store cashier at a cell phone store get a property casualty license. It's not practical. So the industry has evolved. Would it be helpful to have it evolve more uniform? Always kind of against our interest as regulatory lawyers, but policy, we're trying to provide a good overlay so you all perhaps could have a good discussion of where the industry is and whether it's operating effectively or not. But
yeah, I just wanted to quickly add that as my data showed you, last year, in a very high-level fashion, what happened is we sold less product, but we sold more protection. So therefore, the value of protection must have increased in the eyes of the consumer. And I think the consumers are smart enough to realize that a $3 protection plan on an $8 product is not a good value. And in fact, I'll go you one better. I once saw a clock radio that was for sale for $19.95, and the extended warranty was $20. So a rational consumer would essentially buy two, put one on the shelf, and when the other one breaks, just take the other one down. So I think consumers are aware of the value or the lack of value.
And the flip side of that is, I always give reference to my wife and children. She doesn't understand what I do after all these years. She wants somebody to take care of something. Is the air conditioning system working or not? She wants a number to call. It's simple. If somebody can provide an extended warranty that will make sure at all times things are working in the house, especially as people are having to live there over the last year and a half constantly, that's very important. So it's got a lot of consumer uptake, and we've seen a lot of evolution from things of which were about revenue generation to really more of the experience and providing real benefit and real value to the consumer.
We'll take one more question or comment on this topic from Representative Meskers, and then we'll need to move on to our final agenda item.
So the comment on the clock radio was interesting. At 19 with a $20 warranty. I guess I take the opposite point of view, which is if it's 19 and only lasts 6 months, maybe I want the warranty. And I think that what the issue with warranties has to be a claim and loss history on the performance, because when you go to consumer products, if you've got a shelf life on a washing machine, dishwasher, clothes washer, and you buy a warranty for 5 years, and the average life expectancy is 5.5 years, it's just part of the profit margin. So I think the claim loss history is probably somewhere where we need to think about whether it's in the insurance regulatory environment or a consumer protection environment. If we don't collect data on losses and claims, we're essentially potentially offering a product to consumers for a warranty that's not needed because the product shelf life extends past the warranty insurance we're purchasing. Yes. And that may be just a question of, do you define it as consumer fraud? Do you consider, how do you build a rational framework for warranty business? Sounds like there isn't one. That's what I'm hearing.
From the legal side, I would say that's not necessarily always the case, because the warranty that may have come with that appliance may be a year, and within that year, labor is only included for 6 months.
Or 90 days.
Or 90 days. And from my wife's perspective, she wants to make sure that it's working to the life expectancy. It's her experience, not the experience across the spectrum. And that may be peace of mind that they're willing to pay for. The question of what the price is.
Let me give you 2 real-world examples. I'll disguise the names so that there's nobody, the innocent or guilty or not involved. A very large insurance company, 20 years ago, went into the used car extended warranty business. They lost $500 million very quickly in a couple of years. A very large consumer retail company, electronics retail company, started selling extended warranties on rear projection televisions, the ones that had the big screen and the projector was behind it. Well, those bulbs burned out pretty quickly, and those bulbs were $400 each. So if you bought the extended warranty and you kept on getting new bulbs, the retailer took a bath. The losses were incredible. So my point to you is that it's equally likely that the retailer, the obligor, the administrator, or the insurance company will underprice the risk and therefore lose money. It's not always a money-making game. Sometimes a money-losing game because of the lack of information, as you said. You know, that consumers may not know the risks, but sometimes the retailers don't either.
Thank you all. And I appreciate the presentation and the comments from the committee, but we do need to move on to our next topic. We're running just a little bit behind. We'll give our next presenters on measuring risk post-COVID. We'll go about 10 minutes on this topic, and that'll be about 5 minutes past our committee deadline. Those presenters will be David Dean, Chief Strategy Officer of Strategic Risk Officers, and Gary Preisner, Partner in Ironwood Consulting Group. If you gentlemen want to come forward and introduce yourselves and begin your presentation.
Good afternoon. I know you've had a long day. We're going to make this brief, but I think what you'll enjoy what we're going to talk to you all about today. Again, I'm David Dean with Strategic Risk Associates. What we've developed in our organization, we've morphed into a fintech company, and we've developed in the space of enterprise risk management, which is, it's a big word and very confusing in the insurance industry and any industry for that matter. But what we've done is developed a platform and put yourselves in the shoes of a CEO or the board of directors, and you're trying to understand the landscape and the risk of your organization, any industry. We have developed a methodology of aggregating the key data that you need to make good decisions and put guardrails on your risk. Also, from a regulatory perspective, this platform allows and helps those decision makers to stay in line with regulatory expectations. So what I'm going to do is show you, we have a short video that gives you that 30,000-foot view of what we do. And with me is Gary Preisner, our partners. Gary is a subject matter expert in enterprise risk management in insurance and specific to property and casualty. So he's going to give a brief sort of deep dive into how the system works, but it's literally a click, click, click to get down to base data. So we start at the 30,000-foot view and go down. Most systems and technology today in organizations go from the bottom up, measuring every blade of grass and trying to bring that information to the top. So we've started at the top, and we advise and help the C-suite executives on what the key metrics really are that they need to measure to keep themselves profitable and keep themselves regulatory compliant. So with that, I'm going to play this video, and then we'll turn it over to Gary.
As an executive at a property and casualty insurance company, you're faced with a difficult task. It's your responsibility to understand your risk profile and align your risk appetite to strategic imperatives. Currently, risk data comes in from a mix of Excel and standalone software tools and arrives at your desk in PowerPoint reports. They don't provide adequate risk transparency across the enterprise. Why not? Each line of business uses different processes and methods to collect and measure data. They use different measurement scales for key risk and performance indicators. Some reports have dozens of pages of data, and some are so brief you can't pull actionable insights. This variability makes it hard to tell what's a red flag and what's a false alarm. If you can't easily make comparisons to the strategic targets, peer averages, or previously approved policy limits, how can you truly understand your risk profile? Let's say you wanted to drill down and get more info. You'll have to wait while your inquiries pass down the line and then back up to you. How are you supposed to guide your insurance company into the future and comply with state insurance regulatory authorities using this unwieldy approach? What if you could have access to the entire organization's key risk information with a couple clicks from a single dashboard? You can with SRA Watchtower, the risk management platform built by insurance executives for insurance executives. Here's how it works. You can view the whole organization's risk profile in each line of business in these rows. Want to look at a single line of business? Click here. Want to investigate these numbers? Click here and here. Want to compare historical data from 4 quarters? Simple. Watchtower lets you configure your risk tolerance and limits and automatically flags problems so you can spot them and take action quickly. With our patented weighting and aggregation system, Watchtower converts all values into a common 5-point scale so you can get a normalized, enterprise-wide view of your risk profile while staying in control of exactly how much detail you want to see. Would you like to have a true risk intelligence platform to give you more time to focus on optimizing your risk posture and leading your organization to success? With Watchtower, you can.
Okay. Well, thanks everyone. Wanted to start by saying a couple of things before I get into Watchtower. First of all, this is my first time at NCOIL. I consult primarily with primary companies and reinsurance companies, both in the United States and really across the world. I'm a CPCU and I am really interested in enterprise risk management. I've worked on it for a long time. Over the course of the couple of days, we've had a really very interesting and rich set of presentations. And I would start by asking you a couple of questions. What I heard in terms of major themes are fintech, probably market disintermediation through things like Lemonade. We talked about Sandbox. We talked about the existential threat of long-term insurance care on the reserves of this industry. In addition to that, everybody has said an enormous thing that we don't have our hands around yet is ESG. What are we doing on environmental? What are we doing on social? What are we doing on governance? How do they all work with each other? And I could tell you that primary carriers are worrying about this, not as much as they should. Smaller mutuals don't have the resources to think about it. Primarily, it's being driven by the large multi-state, multi-lines. And right now, the people who are far ahead, from my perspective, are actually international reinsurers. And that's percolating down now to US reinsurers. But looking at it, I would ask you as regulators, how are you going to manage the trade-off between the UN Convention on Human Trafficking, vendors, work relations, slave labor, palm oil, extractive industries, firearms, diversity, and everything else, considering that you're coming out of what? You're coming out of clearing clouds from COVID, where you still have to think about pricing, underwriting, distribution, and everything else that you have to worry about within an insurance company, right? Those challenges are great for you if you are sitting in the C-suite, or if you're sitting in the C-suite, or you're the CRO or the CEO, and you have to worry about Sarbanes-Oxley, you have to worry about ORSA regulations. You have those problems every day, and their problems and your problems, I would argue, are the same. How do you make sure, how do we protect our policyholders, right? How do we do that in a world that's getting more complex? And how do you know even how to measure the trade-offs? How do you know which risks to start with first? And honestly, I think you're seeing a lot of people almost throwing their arms up saying, gee, our plate was full and it was very heavy. COVID just did what? It gave us a bigger plate and it heaped more onto it. What do we do, right? Watchtower is one of the things that we've developed that we think actually begins to address that issue, right?
David, do you want to talk about anything, or do you want to just begin?
Roll right into it.
Right. Well, what does Watchtower do? And I think there are three things here, and if you look at it. Number one, which is very important, it creates a single source of truth in terms of your key risk indicators and the things that you have to look at. This is extremely important. Most carriers have, as we said, little pools of data, spreadsheets everywhere, many times no consistent definition of a risk or a key risk indicator from one unit to another, and a tremendous amount of time to spend actually making sure that the definitions are common across the units or recasting them. I've heard so many people talk about, even in this presentation, about we're going to build a data lake, we're going to improve a data lake. Clients, regulators, organizations are drowning in data lakes. They don't need data lakes. They don't need more data. They need the information that can be derived from that data to make decisions or to monitor progress. One thing that's very important is that we create a single source of truth. Secondly, we've all gone through annual audits where we have to go through regulatory reviews. Those regulatory reviews typically, my experience, about 25 to 50% of them are actually involved in data collection before you actually get to audit what you want to audit. This streamlines that process. I think it's going to cut it probably in half. It provides standard executive level dashboards, and most importantly, within the carrier, within the regulators, within the rating agencies, it provides a consistent framework by which organizations can build a risk culture and risk awareness in ways that simply they do not have now. That's an enormously powerful thing for them and for you. You go to the next slide. I'm going to say that the software is not vaporware. This is not something like a gigantic system that's in somebody's eye or somebody's mind but hasn't been done. First of all, SRA was designed by bank regulators, by regulators such as yourself, for reporting purposes for regulators. Point of this slide is simply to say it's in somewhere between 40 and 50 banks being used every day to monitor risk, and banks that go from less than 2 billion to more than 10 billion. It's a flexible system, and it is basically designed for risk monitoring. Working with SRA, I've taken my insurance expertise and that of my team, and we have built a piece of software specifically designed to help you monitor the risks within first the property and casualty organization, but then we're going to also expand it to life and then finally to health. So this system is proven and it works. What is it? Well, if you look at this slide, it's essentially a model we've created that details the 13 or 14 major areas of risk, defines the sub areas of risk, and defines what the key risk indicators are you need to look at quarter to quarter to make sure that the companies domiciled in your regulatory area are actually on track. And if you look at it, we could go through them, but the specific ones for PC would be liquidity and solvency, pricing and underwriting claims, distribution, credit, legal, regulatory, reserving. All the others are ones that any organization has to deal with. So if you're using this for reinsurers, or if you are using it for general agents, strategic, reputational, market, operational, cyber, all the things that people are worrying about. We've put together the risk indicators for them, the sub-indicators for them, and we've given you ways that you could calibrate them quantitatively and qualitatively to see A, where the organization is, and B, we've provided definitions to show where the board would want to be. So you actually see where you are as an organization, you see where the gaps are. This could be updated quarterly, so when you do an annual audit, you could do a quarterly audit. You come in, you prioritize the area where you have gaps, you prioritize the area where you don't have gaps. That gives you your audit plan, and it actually focuses you exactly on what you need to look at. I'm going to start by saying, I talked about the risk culture. This talks about a few of the banks. There's not a lot to this slide. I could go over the slide in detail. I just want to go to the bottom one, to Tri-State Capital, because it says overall, it has made us easier. It's made it easy for the management team to discuss risk in the same language. That, to me, is the critical portion of what this software does and what we as an industry need to be better at. And that is discussing risk in the same language with the same definitions consistently across organizations and within the organization. We had a discussion earlier about workers' comp and COVID. What was going on? People said, we have all this tremendous information. We're all putting it in Tableau and Google Studio, right? Our experience, that's only step one. After you have that information together, the development and the journey you need to go on is basically to take that information, synthesize it into something useful, and then bring it forward. We call that process turning actionable information into decision, starting with hindsight. You see where you have a problem and you look back and see what happened. When you have insight, you begin the process of mitigating it. And finally, when you have foresight, you begin the process of anticipating risk, monitoring it, and improving performance proactively. Okay? I'm not going to spend a lot of time on this except to say that organizations go through that hindsight, insight, foresight development, right? We've put together on the next slide basically a very detailed set of definitions of exactly where carriers fit in this maturity journey. You could take this to any carrier and we have detailed definitions of each one. You could slot it in, you could show exactly where they are. That will prioritize specifically where they need to go, what they need to do to their audit, and how they need to satisfy what they need to do to get a world-class enterprise risk management system. Overall, better bottom lines, better risk decisions, much easier regulatory reviews, and much greater value. This is incredibly important if we are going to get our handle on risk overall as an enterprise in an industry. As the risks become more sophisticated, our monitoring mechanisms have to as well. I'll stop there and basically take questions in the interest of time.
Just as an anecdote, over the last 60 days, we got a call from Google. Their new chief compliance officer was with TD Ameritrade as their chief risk officer for many years. And he used Watchtower at TD. And when he went over to Google, he brought it inside, and they came back and said that we have the best aggregation methodology for the CEO and board reporting that they've ever seen. So we are now, literally in the last 60 days, we're standing up Watchtower inside Google for the entire alphabet. So it's a huge project, but that kind of validates in a big way where the technology is, how easy it is to use, and how deep and wide it can go within an organization. So we're pretty excited about that, and we're very excited about bringing it into the insurance industry, and we're looking for better things to come. So any questions? Thank you so much, Tom and Will, for the opportunity to come and talk to you all, and we really appreciate it.
Thank you all. Thanks for being here. Thanks for your presentation. Are there any questions for our presenters? If not, the members just make note that Watchtower has an exhibit booth out in the lobby, so feel free to stop by sometime during the remainder of the meeting and visit with them if you have any questions at that time. Thank you all.
Appreciate it.
The final agenda item that we will do really quickly is consideration of the readoption of the model law. It's the Property Casualty Flex Rating Regulatory Improvement Model Act. It was originally adopted in 2004, readopted again in 2011 and 16. Are there any questions about the readoption of that model law? If not, I'll entertain a motion that we readopt it.
I'll move we readopt the Property Casualty Flex Rating Regulatory Improvement Model Act.
Have a motion by Assemblyman Cooley, a second by Representative Lehman. Seeing no discussion, all those in favor? Aye. And the model is readopted. Any other business to come before the committee? If not, I'd entertain a motion that we are adjourned.
So move.
Second. We're adjourned. Thank you all.